Good evening, everyone. Welcome along to the Paper 2 Q&A. If you are on TikTok, I highly recommend that you guys come over to YouTube as I'm able to share my screen and go through everything with you guys. I highly recommend that you guys have as much pen, paper on hand. We're going to do a lot. So a couple of things before I start the stream. First and foremost, thank you enormously to all of you guys that have emailed or Instagrammed or TikTok messages and questions. My inbox is flooded with questions. So I am unfortunately going to be a bit annoying in the sense that there are certain topics that we may not be able to cover in the time that we have. I will be a little bit selective about what it is that I think is most worthwhile your time going through. I have a selection of questions that I want to make sure you guys are comfortable with, that you can answer to a very high level. So bear with me. I will get through as much as we can. The other day we did about 2 hours and a half. I can't remember. Today I got my secret weapon. I've been really bad advertising this, but I'm here with you guys. We're going to do at least 3 hours. Yeah, buckle up. Let's get started. So our starting point is to start off with some basic stuff in terms of section A, and I want to make sure that you guys are comfortable knowing how to answer questions in terms of index numbers. Now, before we deal with what an index number is, I want to take you through a very simple method that will help us to work out how to calculate index numbers. Imagine I told you the following. So if I told you that here are miles, and on the right-hand side of our equation, we are going to have kilometers, okay? And if I said to you that for every 5 miles, there are 8 kilometers, which is a true fact, but whatever. And I now want to ensure, or I want to now work out, how many kilometers are there in 4,042 miles? There is a very simple 2-step process that I want you guys to follow that will always allow you to get the answer. And you'll see why I'm doing this in a second when we do a past paper together. The 2-step method is always, step 1 is to divide, and step 2 is to multiply. Always, always, always. So let's work out what I mean by that. The only thing you're not allowed to do is go diagonally. So you lay out your work, so you've got miles on one side, and you have kilometers on the other side, yeah? So what I do is this, I go, okay, if I want to calculate this number over here, step 1 is I'm going to divide. So I'm going to go 4042 divided by 5. That was step 1. Step 2 is always to multiply. So in this case, times 8, whatever that might be, doesn't matter. Now, bear in mind, by the way, this exact method works if I did it the other way. So if I did 8 divided by 5, so this time I've gone from here this way. Again, step 1 is to divide, and then I multiply by 4042. You will get the exact same answer. That is very important to understand. And the only thing I'm not allowed to do is I'm not allowed to go diagonally. I can't do 8 divided by 4042, and I can't do 4042 divided by 8. Now, if I lay out my work in very simple terms like that, it will make my life significantly easier. So let's go through a question together from a past paper. So let me stop this share and take you guys to the following. So in Old Spec, Unit 2 at Excel, June 2013, they had a lovely question which looked like this. So I'll show you guys the data, and then I'll share my screen to show you how to answer it. So here we go. Here's the data, and the question that we're going to deal with is the following. It says, referring to the data in figure 1, calculate an index number for the oil price in March 2012 using January 2005 as the base period. Okay, right. So I'm going to note down a couple of important things from the data together. So we're looking at oil prices. We want to know what the index number is in March 2012 using January 2005 as our base year. Okay. If I look at figure 1 then, this is what we have. So in January 2005, the price of oil was about $45. Not exactly $45. And in the March 2012, at the end of the period, it is exactly 125. Okay, now that I have that information, what I'm going to do now is I'm going to share my screen and show you guys step by step the method that I just showed you, but now in action, and how to calculate an index number like this. So let me stop this share and do a new share. Right. Okay. In order for my method to work, there are 2 things I need. One is I need to understand what are my 2 metrics. Well, one metric is clearly price. So on one side, I've got price. And on the other, I am trying to express it in index numbers. Index over here. And over here, I've got March or January 2005 over here, and March 2012 over here. Right. The first thing I know is I know the price in January 2005. It is $45. So I'm going to put 45 over here. And I also know what the price is in March 2012. It is 125. But my method relies on me having three numbers. I need to have three numbers in order for me to work out the fourth number. But what do you all know about index numbers? What you should know about the index numbers is that there is a base year. And the base year is equal to the number 100 on purpose. The reason why it's set equal to 100 is to make our life a lot easier to compare. So if I told you, for example, that in a given year, the index number is 100, and then the next year it's gone up to 104, that tells me that inflation has gone up by exactly 4%. Yeah? So let's work out what we do then. So we can say January 2005 is our index number, and it's the base year. So that means it is equal to an index of 100. Do I now have enough information to work out the fourth number? Yes, I do. And I can do it in one of two ways. The way I'm going to do it is I'm going to go 125 divided by 45. So that was step one. Remember, we go up. Step one is divide. And step two is we divide, multiply. So step two times it by 100. And that should give you 277.76 or something. Okay? That is how to calculate the index number. Cool? Vice versa, by the way, I could have also done 100 divided by 45 times 125. You could do it in your own time. It would literally give you the exact same number. That is how to deal with index numbers. Cool. Right. One more question I want to show you guys, and then we'll move on to data response, 25 markers, particular topics that are hot topics or like harder questions that could come up. So I've compiled a made-up question for you guys that I'm going to quickly replicate. So let me just write it out over here. So imagine you're given the following, and it has this. So it has components over here, and then it's got weighting in the CPI basket. We'll talk about weightings in a second. In CPI basket, sorry. Right. And that's going to be expressed as a percentage. And over here, I've got the annual percentage change in price. Again, in obviously percentage terms. Yeah? Okay. And we're going to break it up into two parts. So one part is going to be food, and the other is non-food. Some of you may have seen this if your teacher showed you the lock specimen paper, paper 2. I've amended the numbers a little bit, yeah? So the numbers are going to be as follows for us. 32.6 over here, 4.3 over here, 67.4, and 3.2. Oh, first and foremost, it is important for you guys to understand that when they calculate the CPI, so basically the index or the measure of inflation in the UK, they attach weightings to item to reflect the proportion of income that is spent on that good. So for example, hypothetically, ignoring my example for a second, if I have 10 items, and of those 10 items, the first item is people don't really spend very much on it. What I want to make sure is that when the price of that item goes up, it doesn't have a big bearing on my overall inflation number, because it's only a small proportion of what people are spending their money on. That's what weightings are for. Weightings are there to ensure the things that are important, that actually people spend a lot of money on, they account for a large proportion of the inflation number we get. And those that are lower weightings don't have such an impact on the overall CPI number. So how do we calculate the annual inflation rate based on this data? Because a 5-marker could easily be calculate the annual inflation for this economy based on the data provided in figure 1. It's a two-step process. What you guys need to understand is that food prices, in my example, have gone up by 4.3%. So if it was 100% of the weighting, that would just mean that inflation has gone up by 4.3%. True? But what it says to us is that food only is 32.6% of the weighting. In other words, I need the number to be only 32.6% of it is influenced by food prices. There is a very easy way of doing this. And the way you do it is this. You're going to go, what is the change in the price of food? Well, food went up by 4.3%. You do 4.3 times. I want that number, 4.3, to only account for 32.6% of my overall inflation number. So what do? I go times by 0.326 plus that. The other thing I need to factor in now is non-food. And non-food goes 3.2 times. And remember, it needs to account for 67.4% of the overall number. So I do times 0.674. You guys can plug that into your calculator. I think that should give us 3.56 roughly, if you round it up to 2 decimal places. And by the way, intuitively, that should make sense. Can I explain why? Because if non-food has a bigger bearing on the overall inflation figure, can you see that my overall answer of 3.56 is closer to 3.2 than it is to 4.3. That makes sense because non-food has a higher bearing on the overall number compared to food. That's our starting point. Right. Hopefully that's a nice little warm-up for you guys. You're now understanding how to like answer questions like that. Let's jump. Our first topic that I want us to talk about are fiscal deficits and national debts. And the best way to deal with that is through the June 2016 Unit 4 5E. I'm going to show you guys the question and we're going to deal with it together. Right. While I load it up, here we are. So Unit 4, June 2016. Right. This is a great question. Let's have a look. Zoom in a little bit. 5E has the following. So we'll all about Ghana. We'll deal with them later. This is the question. Question is this. To what extent might a high public sector debt to GDP ratio be a cause for concern? Refer to the information provided in your answer. Okay, first and foremost, when students were seeing this exam a couple of years ago, I remember very vividly, they walked out the exam and were like freaked out by the fact that it says high public sector debt to GDP. Oh my God, what is high public sector debt? You guys need to understand something. They are not allowed to test you anything outside of your spec. There is no way that they are going to ask you a question on Monday that is not on the A-level spec. And the only time you ever encounter debt in any format is in national debt. That is it. In other words, the question really is, to what extent is a large national debt as a percentage of GDP a cause for concern? That makes it a little bit more manageable as a question. First and foremost, though, I need you guys to understand what national debt is. And the way to understand national debt is we need to go one step further back and actually define something called the fiscal deficit. What is a fiscal deficit? Two things about the fiscal deficit. It's called a fiscal deficit. It can also be called a budget deficit. It means the same thing. Not to be confused with a current account deficit or a trade deficit. Those are different. Trade and current account is exports and imports. Fiscal and budget is government spending versus taxation. And if they have a deficit, that simply means that the government are spending more than they're receiving in tax revenue in 1 year. That last bit is very, very important. So your starting point is to define the following. Go, fiscal deficit is where government spending exceeds tax revenue in 1 year. Now, if that's the fiscal deficit, what's national debt? Well, national debt is the accumulation of all the unpaid fiscal deficits up to that point in time. So national debt is the accumulation of all the unpaid fiscal deficits up to that point in time. Cool? A little bit of real world knowledge for you guys to know. We'll put this out on Instagram probably tomorrow, but basically the UK debt to GDP ratio is about 100% at the moment. Yeah, roughly in that vicinity. It's quite high, pretty high, basically. Yeah? Okay. Let's deal with this, both in terms of the extract, and I will go through the extract in a second. You guys in your own time can properly whiz through the extract. I'm going to kind of go over it more vaguely than that. But our starting point is to understand a very important concept, which is debt, and why debt is not always such a bad thing for a country. So I'm going to unshare the screen and share my board instead. And the way that debt works is as follows. So the government issue these things called bonds. So imagine I'm the UK government and I issue a bond. Let's say one of you buys a bond. The actual transaction that's taking place is as follows. Let's say you pay me £100 for the bond. What's happening is that I am giving you a piece of paper called a bond. In return, you are lending me £100. That piece of paper now says, I, the UK government, pledge, I'll pay you back that £100 that I just borrowed off you, and I will also give you interest on top of it. Now, one of the most important things to understand is that there's an inverse relationship between the price of a bond and the yield, the interest rate the bond pays out. The higher the risk, the lower the price, but the higher the interest rate. In order for countries to entice you to basically take out or give them a loan, is they're going to give you a high interest rate, and the price will be low because the demand will be low. Vice versa for safe countries. So a safe country, the demand for their bonds will be high. The price of their bonds, therefore, will also be high. But the interest on their bonds will be low because why do they need to entice you with a high interest rate? You know you're going to get your money back. That allows me then to hopefully explain to you guys why debt, in most instances for developed economies, is not such a big deal because of the following. Imagine I am the UK government and I issue the equivalent of £100 million worth of UK government bonds. Okay, so I have just taken out a loan of £100 million. And to make our life easier, let's assume that the interest rate on these loans, on these bonds, is 2%. Okay, really basic maths. I chose 100 to make your life easier. In 10 years' time, so let's say these are 10-year bonds. Okay, 10 years from now, let's make it really simple. How much money does the government need to pay back in total? Well, they have to pay back the £100 million they borrowed, but there's also 2% interest to pay. So how much do they pay back in total? Well, they pay £102 million. Nice and easy, yeah? Now, do you guys agree, though, that when the government collect that revenue, when they take that money, they borrow it, they're going to invest it. They're going to spend it in the economy. They're going to sit there admiring it. What the government will do will spend it is on creating jobs in the public sector. They'll hire more, like teachers, nurses, doctors, blah, blah, blah. And imagine that I could track over 10 years the amount of money or the additional tax revenue the government derive from basically that £100 million investment. Hypothetically, let's say after 10 years, it made £105 million for the government. Fair? Now think about what the government does now. The government, of the £105 million they've just generated, now give back £102 million to the people that they basically borrowed the money from. But what are they left with? Well, the government are left with a £3 million surplus. True? That means that the government just made money on their loan. That's amazing. That is why for countries like the UK, like the USA, like Germany, debt is not like debt for an individual. Debt for a country is very, very different. Make sense? So that is understanding why debt is not necessarily always a cause for concern. Park that thought for a second, but I need you to understand how this all works. Within the world of bonds, there are these institutions called credit rating agencies. Credit rating agencies, their role is to indicate to investors how safe or risky a particular country is. Now, the only rating that I need you guys to know is the top rating, which is called AAA. You write it out as 3 capital A side by side, yeah? Because beyond that point, by the way, every different agencies have different ratings, yeah? From there on, we're just going to talk about its upgrade and downgrade. If a country is a AAA rated country, what that means is they are like the safest of the safe. Examples will be like Canada, Australia, New Zealand, Norway, like really stable, safe economies, yeah? And if you are a AAA rated country, think about demand for your bonds. Do you expect the demand for your bonds to be high or low? Well, the demand for your bonds realistically will be high because you're super safe. The price of the bond, therefore, will also be high, but the interest rate, the yield that you get on that bond will be low. Why would you expect to get a high return when this country is super safe? You know you're going to get your money back. So in other words, high price, low yield. For a country, then, you want to have a high credit rating. You want a credit rating to be as good as possible. Okay, with that in mind, then, if a country's debt as a proportion of its GDP starts to get higher and higher and higher, like in the extract that we're going to read in a second, do you think that will result in an upgrade or a downgrade in their credit rating? Well, obviously, if they have higher levels of debt, that may translate into a downgrade in their credit rating. And if their credit rating gets downgraded, what would happen to the demand for their bonds? Well, in theory, the demand for their bonds will go down. And if the demand for their bonds goes down, what happens to the price of the bond? The price of the bond also goes down, but the interest rate on their bonds will go up. Does that make it easier or harder for the government to service their debts? Fancy way of saying pay off their debts. Well, do you agree that it makes it harder? Is that a cause for concern? 100% it's a cause for concern. So if you get a question in relation to, are high debts a cause for concern? Your first analysis, oh my God, yes, because of the fact that it may lead to a downgrade in your credit rating. Therefore, there'll be less demand for your bonds, lower price of bonds, higher yield for your bonds, harder for your government to service and pay off their debts. In other words, the chances of them going bankrupt go up. That is our first analysis, and that is exceptional analysis. Yeah? Let's evaluate. Now, in order to evaluate, I'm going to need to read the extract with you guys. So let me just share the screen. Those of you that are joining late on TikTok, I highly recommend you join on YouTube as well, because then you can see my screen at the same time. Right. We are going to read particular parts of the extract. I'm going to be very specific because just to save time. And over here is what we're going to talk about. Yeah. So this paragraph over here. Okay. The paragraph says the following: the fall in the general price level in Italy is raising the real value of debt. Between 2007 and 2013, the ratio of public sector debt to GDP rose from 103.3% to 132.6%. If Italy's economy continues to stagnate in 2015 and 2016, the debt to GDP ratio will be heading towards 150% of GDP. The problem is not the number, but the trend, which could ultimately result in Italy becoming insolvent. By the way, that word insolvent is a fancy way of saying going bankrupt. Yeah? Basically declaring bankrupt, defaulting. Yeah? However, by the way, when they use the word however in an extract, that is a clue that it's an evaluation. You need to look for the word however. Anyways, however, Japan is still solvent at a debt to GDP ratio more than 200%. That I want us to zoom into. I want us to talk about Japan, because Japan provides a very interesting case study in terms of why massive debt. By the way, Japan's debt is the highest debt in any developed country in the world. It's over 250%, I believe now. It is mental, their debt. Yeah. And yet, despite it, I would argue that Japan's debt is still not a major cause for concern, which begs the question, Why? How can they have debts that are exceeding 200%? And yet I'm going, it's not a cause for concern. Let's work it out. So if I go back again to my board, in my made up example over here, where the government issued £100 million worth of bonds, what was the most important number in this very simple made up example? Well, the most important number is actually this, the 2%. Because if the interest rate on your bonds suddenly goes up, for example, the UK, because of Liz Truss's incredibly awful budget, mini budget, the UK bonds, the demand for them dramatically fell. Investors were like, whoa, this is a very unstable economy. It's getting a bit stupid here. And therefore, the price of the bonds also went down, but the interest on UK bonds went up to the point where the interest rate at one point during all of that the pandemonium was 7%. Right, for that number now changes to 7% from 2%. You know how earlier I said the government pay back 102 million? How much are they paying back now? Now they're having to pay 107 million pounds. Agreed? And if they're paying 107 million pounds, but they're only generating 105 million, what are they now making? They're now making a loss of 2 million pounds. Now it's a massive cause for concern. In other words, you are only concerned about a country's debt if the interest on their bonds is high. If the interest on their bonds is low, all good. And that gives us a clue about what's happening in Japan. Because if I'm telling you that Japan have insane levels of debt, and yet it is not a cause for concern, that would imply that the interest on their bonds are low, which you don't need to know this, but just for your own sake, who is therefore buying Japanese bonds? Because the demand must be high. The price must be high for their yield to be low. The answer is really, really interesting. The answer is the vast majority of Japanese bonds are bought by Japanese people, because Japanese people are smart. And they understand that unless they buy their government bonds, keep the price high and keep the interest rate low, their economy would collapse. And if their economy collapses, who hurts the most? Well, Japanese people, their jobs are at stake, their livelihoods are at stake. Therefore, there's a culture of constantly buying government bonds as a means of reducing interest rates and keeping them low. It's mad. Anyways, right, you don't need to know to that level of depth. But what you do need to know is the idea that actually just because your credit rating got better or worse doesn't mean the interest on your bonds are going to do what we just said in the analysis. So if I take us through the extract once again, in the extract, there's a really interesting statement, which is this. It says, if investors believe that the country's debt can be stabilized at any given level, they will continue to refinance its debts. In other words, what that means is, imagine if I owe £100 million worth of bonds tomorrow, yeah? As long as I can go back to the bond market today and issue bonds at a low interest rate, I'll take the money that I just borrowed, give it to the people that basically are owed the money tomorrow, and it's like a cycle. It's like a Ponzi scheme, basically. Yeah, you get in line. Yeah. Anyways, in a nutshell, the evaluation is going to be as follows: however, Japan has a higher debt to GDP ratio than Italy, and yet they are still solvent. In other words, they haven't gone bankrupt. You then explain that even though the credit rating may get downgraded, as long as the demand for Italian bonds remains high, the price of their bonds would remain high, and the interest would remain low. All good. Not a cause for concern. Vice versa, by the way, if the question was, if their debts are going down, is that good? Analysis would be, yeah, great, credit rating goes up, demand for the bonds goes up. Greece is an example, by the way, their debt as a proportion of GDP has come down in the last 2 years. Okay, good. As analysis, we simply go, credit rating improves. But the evaluation is, but that may not necessarily result in people buying more Greek bonds, because Greece recently had a massive bailout from the Eurozone and the IMF. Greece still has the highest level of debt in the Eurozone. So are people necessarily going to start buying bonds? Maybe not. That's the evaluation. Right, so that's half of our essay. Second half of the essay. Second half of this particular essay is to talk about something specific to the data, but allows me to hit a couple of stones, or a couple of birds, with one stone, which is, there is a line here that I read out to you guys, and I suspect the vast majority of you, it would have just gone over your head and you didn't realize what was happening. It is the very first sentence in this paragraph, which says this: the fall in the general price level is raising the real value of debt. Okay, whoa. Let's chat about that. What does that mean? The first part of this means that their price level is falling. Price level falling is deflation. Deflation is bad. Just to explain quickly, by the way, first thing about deflation that's problematic is people's expectations about what will happen to prices tomorrow are based off what they observe today. If I therefore see prices falling today, I anticipate that they're going to go down again tomorrow. I therefore withhold spending, especially what we call big ticket items like a house, a car. The issue then is that people hold back on spending because they're waiting for a bargain price. Things like house prices start to go down. If house prices start to go down, you experience, say, Negative wealth effect. Consumer confidence therefore goes down. Consumption therefore goes down. AD shifts in. Economic growth contracts, goes down. Unemployment goes up. There's more deflation. It's like a spiral. Anyway, it's bad, basically, yeah? The other bad thing, though, about deflation is that it increases the real value of debt. This is how to understand why that is the case. Imagine I owe you guys £100. And let's say, for argument's sake, that the price of a chocolate bar today is £1. How many chocolate bars can that debt owe you, can buy you? Well, the £100 could buy you 100 chocolate bars. Is that fair? Okay. Let's assume now that I still owe you £100 in nominal terms, yeah? So the debt is still £100. But now, because of deflation, the price of chocolates goes down to 50p. How many chocolate bars can you now buy? You can now buy double the amount of chocolate. True? You can now buy 200 chocolates. In other words, the real value of what I owe you has gone up. Well, if you're a country that has high levels of debt and you have deflation, you are in big trouble because the real value of your debt is going up. Uh-oh, big problem. Now, we'll make this point even better. So the first thing is go, okay, this is a problem because of the fact that the real value of their debt is going up. One, to make matters worse, Italy are part of the Eurozone. And I promise I don't know, and I don't want to speculate or anything like that. I think an extract on the Eurozone is very overdue, whether it's in paper 2 or paper 3. And we'll talk about potentially them asking a question about a monetary union later today. But anyways, Italy are part of the Eurozone. Now, what policy tool do you normally use to get yourself out of deflation? Well, you use something called monetary policy. Monetary policy is changing interest rates or like quantitative easing. True? Okay. Let's assume that you guys are the central bank. Firstly, actually, the problem is Italy are part of the Eurozone. Can they set their own interest rates? Well, no, they can't. That in itself is a massive problem. But even then, now you would know this if you were sitting in June 2016, I promise, in the way that you would know that inflation right now is pretty high in the UK, or well, relatively higher than the target, blah, blah, blah. Those that are sitting in 2016, and if you looked at the 2017 paper 2, it talks about the Eurozone interest rate. If I were the head of the, let's say, central bank in Italy, if they had their own central bank, what kind of interest rate would I necessarily want? Would I want a high interest rate or a low interest rate? Well, I want a low interest rate to shift aggregate demand outwards. In fact, you know what? Let me share my screen, just illustrate why. Right. So if you're experiencing deflation, you badly want some demand pull inflation. You want to shift your aggregate demand curve outwards, yeah? And so let's work out what I need to do to my interest rate in order to achieve that. To understand what I need to do to get my inflation rate up, something like this. So this is price level, this is real output, yeah? I want to obviously shift aggregate demand outwards, yeah? So AD, I want it to go somewhere over here to achieve demand pull inflation. So do I want a high interest rate or a low interest rate? The easiest way to understand which interest rate you need is to ask yourself one question. It's all about savings. So if I told you, let's say, raise the interest rate. If interest rates go up, are you more or less likely to save money in a bank? Well, do you guys agree that if interest rates are higher, you have more incentive to save your money in the bank because you get a higher rate of return? If savings are therefore going up, consumption would be going down. AD therefore would shift inwards. I don't want that to happen. Obviously, then I basically want to do the opposite. In other words, I want to not raise the interest rate. I want to reduce the interest rate. So I'm all right. Italy are part of the Eurozone, so they can't set their own central bank interest rate. But despite that, the base rate in the Eurozone at the time was negative. It was like either 0% or minus 0.3%. Right. In other words, was the interest rate exactly what they wanted? Yes, it was. And yet they were still experiencing deflation. That indicates that they were suffering from a very cool concept known as a liquidity trap. That is an incredible analysis, but can I explain what it means? Let's talk about what a liquidity trap is. So the best way to understand liquidity trap is the following. So imagine that the base rate, so this is the rate set by the Bank of England, or let's say the European Central Bank in this case, yeah? Let's say the base rate was cut to negative, to minus 1%. Okay? That means that if HSBC take out a loan of 100 euros, they would only need to pay back 99 euros. Cool. All right. You'd expect them to start lending freely, right? You go, oh, go on then, lend. It's literally like you have to pay out less. But that's not true. And the reason why that's not true is because from HSBC's perspective, they still have to factor in how risky that particular person is if I gave them a loan. If I gave a loan to someone who has a terrible record of paying back debt, and then they don't pay back their debt. So let's say I gave you a loan of 100 euros, and then you go, oh, I'm really sorry, I've defaulted. I've lost your money. Do you agree that I still make a 99 euro loss because I have to pay back 99 to the Bank of England, or the central bank? True? Therefore, banks have a lower level that they're going to reduce their interest rates to, where they go, I don't care what happens beyond this point. Beyond this point, I am not willing to reduce my interest rate any lower. Let's say hypothetically for HSBC, their ceiling is 3%. They go, listen, no matter what happens, I am not willing to reduce my interest rate below 3%. I don't care what you do. And the reason why is because if you think about it, if I get money from you guys, so let's say I have 3% in my bank account, I'm HSBC. Do you agree that I could lend that money to the government and buy a bond for, let's say, 2%? Okay. What's safer, lending to the government or lending to a firm or lending like to an individual? Do you guys agree that by miles, lending to the government is significantly safer than lending to an individual? If the interest rate on bonds are 2%, how would you ever expect us to get 2% interest from the bank? How would you ever expect the bank to ever lend to you at 2%? They're not. That's the point. The point then is to say, look, if they are at the lower level of what their interest rate is, they would be unwilling to reduce it anymore. That's it. Yeah. That means that they will be suffering from a liquidity trap. Simple as that. That is an incredible analysis. And that's your second analysis, by the way. But let's now evaluate. And I'll tell you guys, by the way, an alternative analysis that we could have done as well. I'll deal with that in a second, just in case it was the other way around. But in terms of the evaluation, if you think about it, if your debt as a percentage of GDP is going up, one of two things is happening or both. Either your debt is rising or your GDP is falling or both. Okay. Then in order to get out of this trap, the government could promote fiscal policy to shift AD out. If the government, for example, spend more or they tax less, do you guys agree that that hopefully translates into aggregate demand shifting out? Two things happen. One, economic growth goes up. So therefore, as a result, you basically get a reduction in the debt as a percentage of GDP. But two, if you visualize it on a diagram and AD shifts out, what now happens as well is that hopefully you get demand pull inflation. And if you get demand pull inflation, you no longer have deflation. Great. The extract literally gives you the answer, by the way. It says economic reforms may help to generate some growth, but only in the long run. Yeah. For example, here it is, this bit. Italy needs to bring its taxes down to the Eurozone average. Okay. If Italy cuts their tax rates, so let's say the income tax rates are cut, do you guys agree that what will happen is that you individuals will have more money left over to spend? So if I tax you less, you have more money left over in your bank, on your kind of account. What happens to consumption? Consumption, the biggest component of AD, now goes up, AD shifts out, and therefore you generate growth. That's the evaluations. The government could do something to try and rectify this. This might not necessarily be such a big issue now. That is the eval. Is that super duper clear? Can I reverse the question in case the question instead was about whether a reduction in the debt to GDP ratio is a good thing? The analysis, we did one, which was credit rating and all of that. The analysis here is to talk about a concept known as crowding out. I need you guys to understand what crowding out is. Crowding out is basically whereby when the government spend money, the public sector grows. So, for example, like state education, healthcare, they benefit from the government spending more money, but that is detrimental to the private sector. The best way to understand this is the following. Imagine that you and I, we own a private health clinic in whatever area, okay? And initially, business is booming, we're doing really well, it's amazing, right? And we have loads of customers. Now the government, when they decide to spend more money, they, despite, not to spite us, they decide to build an NHS hospital across the road from us. Is that good or bad for our business? Would you guys agree that that's pretty bad for our business? Because a lot of our customers will now go across the road to the free hospital rather than coming to us. In other words, resources are diverted away from the private sector, us, to the public sector. There's going to be job losses in the private sector. There's going to be, unemployment in the jobs in the private sector. Blah blah blah. Let's reverse it then. If you suddenly have the government reducing the size of the public sector by reducing their debts, do you guys agree there'll be less crowding out in the economy? And if there's less crowding out in the economy, what does that mean? It means that the private sector now can flourish. And if there is more involvement in the private sector tends to be more efficient than the public sector. And the reason why is because the private sector are accountable to shareholders. So therefore, they're more likely to invest into new technology. And investments into new technology shifts out the LRAS curve and leads to higher levels of economic growth. Is that clear? That could be a reason why a reduction in the debt to GDP ratio might be a good thing, because it could result in the government cutting down in spending and reducing the size of the public sector. Therefore, who's going to flourish? Well, the private sector. Now, you can do that in terms of financial crowding out as well. I don't mind. So that's completely fine as well. Yeah. Anyways, if I were evaluating that. So again, the question I'm now dealing with is a reduction in the debt to GDP ratio a cause for concern? Yeah. The way I would evaluate it is by saying, okay, well, if the government are cutting spending, What if they're cutting into really important areas of the economy? Where might they be cutting? Well, the government might be cutting into areas like education, healthcare, infrastructure. So what would shift? If the government are cutting into those areas as a means of trying to reduce the deficit and national debt, the LRAS curve may shift inwards. And if the LRAS curve shifts inwards, not only do I get negative growth, I also get something called cost push inflation. As a result, you might even get something called stagflation. That is bad, really bad. Living standards are on the floor. That is a superb evaluation, by the way, if I was dealing with a question about whether reducing the national debt as a percentage of GDP is a good thing. Well, if they're cutting into the public sector in that way, no, not a good thing. That is that essay done. Hopefully that makes sense. And let's move on to another question. Right. What I would like us to talk about is exchange rates. I want to make sure that you guys are really comfortable with exchange rates, that you know how to answer questions in relation to exchange rates, and also kind of the consequences of exchange rate movements. So let's start off with kind of causes of appreciations and depreciations. So let me share my screen and let's rock and roll. Right. I'd argue that this is one of the topics that students overcomplicate for absolutely no reason whatsoever. And if you just follow this method, it will make your life so much easier. When it comes to exchange rates, I need you guys to understand that I always need you to think of it through supply and demand, always, yeah? So let's go through some hypothetical scenarios first. And then once we've warmed up, I'll show you guys an extract and we'll work out together, yeah? Let's start with the following. So if I want to do, let's say, the pound is in a floating exchange rate, meaning that it's just pure supply and demand. The government or central bank don't intervene to manipulate the pound, yeah? So what we're going to have on the axes is as follows. We're going to have on the y-axis the price of pounds in any currency. So let's say price of pounds in, let's say, euros, okay? And on the x-axis, we have the quantity of pounds. And this is the supply curve, S1. This is the demand curve, D1. And this is Q1, P1. Right, can I clarify a few things about the foreign exchange market? First things first. The foreign exchange market is not when you and I are buying goods and services in like a shop in the UK. If I go to the shop and I buy something in the UK, that is not me partaking in the foreign exchange market at all, yeah? What would be foreign exchange market is, you know, when you're about to go on a holiday and you go to one of those exchange booths, so then you're going to basically convert your pounds into, let's say, dollars or euros. Now you are partaking in the foreign exchange market. So this is a market where people are buying and selling currency, yeah? Now, I'm going to give you guys a scenario, and together we'll work out what happens on the back of that scenario. The first is fairly topical because of what's happened in the last year or so in the UK, is if inflation is higher in the UK, what does that mean for the exchange rate? Let's work it out. Can I clarify a few things? One of the common misconceptions is that people mistakenly confuse the inflation rate with the exchange rate. They're not the same thing. The inflation rate is the prices of goods and services in your economy. So for example, here the Red Bull, it's £1, £1.90. If this Red Bull can went up to £2, that is inflation because the price of the Red Bull can went up. Exchange rate is the value of one currency in terms of another currency. So they could also, by the way, do the total opposite. You could have inflation going up and the exchange rate going down. They're not the same thing. Let's work out what happens when inflation is high in the UK. This, by the way, is based off the June 2016 paper, question 4. It's about Ghana. And it said that there was rapid inflation in Ghana. Okay, what happens then? Well, in the UK, if inflation is high, does that make UK goods more or less price competitive? Would you guys agree that they become less attractive? They become less price competitive. In fact, you know what? Can I go on a quick detour just to kind of clarify something? Exports minus imports, which we're going to deal with in a lot of detail today. Exports minus imports, I need you guys to get your head around the following. The current account is so straightforward if you remember it in terms of two countries. There are two countries that I always want you to remember when it comes to trade or the current account. Same thing. China, Germany. Why do people buy Chinese goods? Well, people buy Chinese goods because they're cheap, right? Therefore, they are what we describe as being price competitive. Why do people buy German goods? Well, German goods are not cheap. What are they? They're known for their quality. Think about German brands like BMW and Audi and Mercedes and, I don't know, Adidas and whatever, right? These are all German brands. They are quality. In other words, as long as you remember it as either you're price competitive or you're quality competitive, that's all you need to remember. Let's reverse back to this. Okay. We just said inflation in the UK is high. Does that make the UK economy more or less price competitive? Well, obviously less price competitive. We're less attractive. Is the demand for British goods likely to go up or go down? Would you guys agree the demand for British goods is going to go down? True? If the demand for British goods goes down, does the demand for the British pound go up or down? Simply put, there'll be less demand for the pound. Therefore, demand would shift inwards. That is what I wanted you to do. And that's D2, causing, now once you've shifted it, now you can work out what happens. And if you look at my diagram, the inward shift of demand causes the currency to depreciate. If there's high inflation, you'd expect the currency to depreciate. Cool? I could have done that in a different way. Now, that's the way I prefer you guys to do, but I want to show you another way. The other way is as follows. So imagine I did the following. So let's get rid of this now. Right. That was looking at it through the perspective of someone outside of the UK going, I don't really want to buy as many British goods. Let's deal with it through the perspective of people within the UK. Okay, we're in the UK. If I told you that inflation in the UK is high, do you want to buy British goods or foreign goods? Well, do you agree that foreign goods, relatively speaking, are now cheaper? So you want to buy foreign goods. You want to import more. How do I buy more stuff from abroad? Well, the way I buy stuff from abroad is I need to be selling my pounds and buying other currencies. You know, when you're about to go on holiday, people describe that as like converting your money. I don't like that as an explanation because that's confusing. I need you guys to understand it in terms of there's always a buyer and a seller. So if you have pounds and you're giving away your pounds and getting, let's say, dollars, what you're really doing is not, yeah, you are converting, but technically what you're doing is you're selling your pounds and you're buying dollars. So in the context of the pound, if suddenly there are loads of people selling pounds in order to buy other goods from around the world, what's happening? Do you agree that there are more sellers, therefore the supply curve shifts out? So I could have also shifted supply out, causing again the currency to depreciate. Again, it depreciated. There were two routes to the same thing. Make sense? Okay, right. Now that we basically have gone through that as a concept, I want to take you through two things. How central banks can devalue a currency or revalue a currency, how they can manipulate the exchange rate and either revalue, in other words, make it stronger, or devalue it by making it weaker. And in order for you guys to understand that, you need to understand what foreign reserves are. Foreign reserves are just a fancy way of describing other currencies in your economy. Example, in the UK, foreign reserves would be dollars, yen, euros, any other currency, yeah? And if you just remember this two-step process, it will make your life so much easier. Now, I appreciate the UK doesn't have a fixed exchange rate, nor does it have a managed exchange rate. But let's just use the example of the UK to get our head around it because it will make our life a bit easier. Right. So let me just undo something that I've just drawn over here. Right. Right. So let's deal with it. The Bank of England or the central bank in whichever country we're dealing with can have one of two influences on the exchange rate. They either will sell their currency and buy up foreign reserves, or they're going to buy their currency and sell foreign reserves. What I always want you to do is step one, do the thing they need to do to their currency. Because always, by the way, it will cause demand to shift out or supply to shift out. This is what I mean. Okay, let's devalue the pound. We want to devalue it. Okay. The first thing I need to work out then is if I want to make the pound weaker, am I going to be shifting supply outwards or demand outwards? Do you guys agree that I need to shift the supply curve outwards in order for the currency to get weaker? Therefore, I know what step one is. Are they buying or selling pounds? Well, do you guys agree that they must be selling pounds? So the first thing we're going to go, okay, to devalue the pound, I need to sell pounds. And then if I'm selling pounds, I literally have to do the opposite to my foreign reserves. So what am I doing to my foreign reserves? I'm obviously buying. So I'm selling pounds, I'm buying foreign reserves. Cool, easy peasy. What about if I want to revalue? If I want to make my currency stronger, what do I now do? Step one again, remember, think of what the central bank needs to do first, and then the opposite they do with foreign reserves. Well, in this case, if I want to revalue my currency, so let me just get rid of this bit. So ignore my random lines here. If I want to revalue the currency, which way do I want to shift? Am I shifting demand out or supply out? Well, obviously demand out, because I want the currency, the pound, to be stronger. Can you guys see that that would cause it to appreciate, yeah? Okay, so what am I doing? I'm obviously going to demand, in other words, I'm going to buy pounds. I'm going to buy pounds in the foreign exchange market. And I am selling, what am I selling? I'm selling the opposite. I'm selling my foreign reserves. Easy peasy. That is how you manipulate your exchange rate. Now, the other way that you could have done that as well is through interest rates with hot money flows. So imagine, for example, if the Bank of England decide to raise their interest rate, which has happened fairly recently, not for the purpose, to be honest, of the exchange rate. That wasn't why they were doing it. It was because of inflation. But let's say they raise their interest rate. Okay, let's think about it in terms of hot money flows. You don't go, let me clarify what hot money is. Hot money is basically investors around the world are moving their money between different bank accounts based on wherever they get the best interest rate. You know, when you put your money in a bank account, What you're basically doing is you're lending money to the bank, and in return, you're getting your money back plus interest. Normally, it's pathetic, but you're getting something, right? So if you're an investor with millions of pounds in your bank account, you're constantly on the search for whichever bank is going to give you the best rate of return. Yeah. Example, by the way, Unit 4, June 2013, question 5 is about Brazil. And one of the things in the extract it mentions is the fact that a lot of the super rich were putting their money in Brazil because their interest rates were way higher than like the US, UK, and continental Europe. Anyways, that means that there would have been an inflow of hot money into Brazil. Okay. In this context here, if the Bank of England raised the interest rate, do you guys agree that that translates into more demand for pounds because more people would want to leave their money in British bank accounts? Demand, therefore, would shift out, causing the currency to appreciate, or in this case, revalue if they're doing it on purpose, yeah? If I want to devalue my currency, what do I do to my interest rate? Well, I reduce it. Because if I have low interest rate, hot money will now flow out. Investors go, it ain't worth my while keeping my money here. What I'm instead going to do is I'm going to sell my currency, buy, let's say, euros, yen, dollars, whatever currency I want to move it into, and park my money over there instead. Okay? Let's make sense of this and make sure that you guys understand it. By looking at the October 2020 paper, paper 2, I want to walk you through this particular question. So, new spec. Right, running out of fuel. So, Edexcel paper 2, 2020. Here we go. Oh, actually, it might be paper 3. I lie. It's paper 3. My bad. It's paper 3. I'm being stupid. Here we go. Paper 3, 2020. It's all about Turkey. Let's deal with it. Okay, right. Here we go. Hello, Turkey. And we have 2 questions that I want us to look at together. The first is the 5 marker, which says the following. It says, explain how the Turkish central bank intervenes in the currency market to prevent excessive appreciation or depreciation of the Turkish lira. Now, you in your own time can now watch, go through this paper together, like in your own time. In a nutshell, I'll summarize what was happening. The currency, the lira, was in free fall. It was falling like mad in the extract, yeah? So this question, by the way, the key word here is all, yeah? What you should not be doing is talking me through both how they revalue the currency and how they devalue the currency. No need, waste of time, it's a 5 mark. All I would do here, now there's no right answer, but what I would do is, given that the currency was getting really weak, I would just talk about how they revalue the currency. How do they revalue the currency? Let's do it together. If I am the Turkish central bank, how do I intervene in the market to make the currency stronger? The first thing you need to do is go, do I buy lira or do I sell lira? I buy lira. Because if I buy lira, demand shifts out. And therefore, if I'm buying lira, what am I doing? I am selling the other thing. I am selling foreign reserves. Easy. The 5 marks are earned in the following way. The first thing that you would do is quote from the data to talk about how the lira has significantly depreciated. It's like the first sentence or two. It's like very early on. Yeah, here it is. It's lost nearly a third of its value against the US dollar. 1. The second thing that I would do is I would say, as such, the central bank would want to revalue the currency, and they can do this by buying lira in the foreign exchange market and selling foreign reserves. I draw a supply and demand diagram. I'd shift the demand curve outwards. Obviously, on the axis, by the way, on the y-axis, now you have the price of lira in, let's say, dollars, and the quantity of lira on the x-axis. Once I've shifted the demand curve outwards and explained that they've now revalued the currency, how many marks have I got? I have 5 marks, like that, instant. Because of the fact that that is literally the answer. It's as simple as that. That's all you had to do. If it was the opposite, by the way, when they were devaluing, what would we do? We'd be selling the lira, we'd be buying foreign reserves, and that causes the currency to get weaker. Clear? Right. Since we're on this question, and because of the fact that I suspect a lot of you guys were in for a very rude awakening on the exam on Wednesday, by the way, quick word of caution about the exam. The amount of you that messaged me or emailed me about what did you think of the paper? Oh my God, that 10 marker, that 25 marker? Like, guys, leave it. It's gone in the past. Like, you can't change anything about your answers. It doesn't matter. Stop wasting energy, time, fighting each other on like TikTok and Instagram. Who cares? It's gone. Yeah. Now, importantly, though, one of the things that hopefully you learned from that exam was how time pressured this exam is and how I banged on about there's one question that kills students in an exam more than any other question. I always talk about it as the killer question. The killer question is the 8 marker. The 8 marker is the question that you probably in the exam on Wednesday wrote way too much for. And congrats, you might have got 8 out of 8, but it destroyed you for the 10. It destroyed you for the 12, for the 15, and the 25. That is not going to happen on Monday. And the reason why it's not going to happen on Monday is because I need you to understand something about the 8 marker. The 8 marker is like bullet points. It is the last question in the exam where it is non-subjective. you're not placed into levels. It literally goes knowledge, application, analysis, knowledge, application, analysis. There's your 6 marks of KAA, 2 marks evaluation. Can I show you how easily we are going to answer this 8 marker like that? I want it to be answered in less than 8 minutes. This is the example I want to go through of an 8 marker to show you how easily we can get the marks, yeah? Right, together. It says examine 2 reasons why the Turkish government may want to avoid a significant fall in the exchange rate of the Turkish lira. Okay. In other words, why do I not want there to be a significant depreciation of my currency? There are 2 instant answers. Now, obviously, I'm giving you the answer. You could sit back if you're watching this later on. You can replay it and then attempt it yourself. The first, again, the data is so helpful. The first thing it says to me is Turkey is highly indebted in foreign currency. Okay, big problem. Big problem for developing countries. A lot of the debt that they owe to institutions like the IMF, the World Bank, are quoted in dollars. If you're therefore in a country with low foreign reserves, and I'll deal with this later when we do economic development, but if you're in a country with low foreign reserves and your currency now depreciates, you're in big trouble. And the reason why you're in big trouble is because do you agree that you need to now convert more and more lira in order to get one single dollar? If I owe, therefore, let's say $100, and hypothetically, let's assume that 1 lira bought $1 initially, yeah? Do you agree that I just needed 100 lira to pay for the $100? But suddenly the lira gets weak, meaning that now 1 lira buys me 50 cents. It buys me half the amount of dollars. Do you guys agree that I need to now convert 200 lira to pay for the exact same amount of debt? That is my first analysis. And I want to show you how you answer this in 3 steps in terms of the knowledge marks, yeah? Or the paragraph. Step 1, I want a clean topic sentence where you literally answer the question in 1 sentence. You go, 1 reason why the Turkish government may wish to avoid or may want to avoid a significant depreciation of the lira. I'm using the wording of the question and chucking it back at them, by the way, is because it would increase the real value of their debt. 1. That sentence, by the way, gets me a knowledge mark. I need you guys mentally in the exam to be marking your 8 mark. You go, 1 mark. That's my knowledge mark. Instantly, straight away, I want you to give me the application mark like that. According to extract A, quote, Turkey is highly indebted in foreign currency. Boom. 2nd mark. That's my knowledge mark. Sorry, that's my application mark. I got 1 knowledge mark. I got 1 application mark. 3rd mark is the analysis. Maximum 2 to 3 sentences. If it's really difficult to explain in 3 sentences, I allow you 4. But you really shouldn't need 4 sentences to explain the concept. So how do I explain it to get the analysis mark? Is, as such, a depreciation of the lira would make it more difficult for the Turkish government to service their debts, as they would need to convert more and more lira to purchase $1. 3 marks. That's it. How easy was that? It's 3 sentences. Knowledge mark, application mark, and analysis. Easy. We now do the same thing for the 2nd analysis. And the clue, by the way, again in data, is this. At an annual rate of 25%, Turkey's inflation is alarming. Okay, let's chat. How can I link exchange rates to inflation? In order to do that, let me share my screen. So I'm going to unshare this. I'm going to share you my board. Let's go, people. I think the Red Bull is starting to kick in. I'm getting hyped. So let's talk. One of the things you need to understand is SRAS. SRAS is so straightforward, yeah? SRAS is basically immediate cost factors, things that immediately impact the cost of production for your firms. So let's create a list of different things to look out for SRAS, yeah? So here's SRAS over here. And essentially, SRAS is influenced by immediate cost factors such as oil. So if oil prices go up or down, which is quite topical, by the way, or gas prices go up or down, do you guys agree that firms realistically use oil as part of their production process? If oil prices therefore go up, as they have in real life, SRAS would shift inwards because of the fact that it's now more expensive for firms to manufacture their goods. Easy. Another thing that would impact it, so gas, oil, etc., right? Another one is going to be wages. So the UK government, let's say hypothetically, I know they haven't, but let's say they decide to reduce the minimum wage, okay? What does that do? Do you agree that decreases the costs of production for firms? As a result, SRAS would shift outwards because their costs of production have gone down. Easy peasy, yeah? The last one, though, that I really want you to make sure you understand is exchange rates. Because of the following. Every single firm, no matter where they are in the world, will definitely be importing some of their raw materials. They have to be. There's no country on earth that has all the raw materials in one place. So every single country, whatever they are, whoever they are, will be importing some of their raw materials. And now I've told you that the lira has depreciated. Okay. If the lira has depreciated, are your imports cheaper or more expensive? Well, your imports are now more expensive. Your currency is weak. You need to convert more lira to be able to buy a dollar, right? In other words, it becomes more expensive for you to import your raw materials. And if it becomes more expensive for you to import your raw materials, what's happening to your SRAS? Well, your SRAS curve is shifting, in the famous words of Beyonce, to the left. And here we go. SRAS in. And what does that give me? Well, that is going to give me demand pull inflation. And the extract just said something. It said at an annual rate of 25%, the inflation is alarming. It's alarming. It's bad. Let's get the 3 steps again to get the 3 marks. We got 3 out of 8 so far. Let's get 6 out of 6 in the analysis. Step 1. Step 1, you straight away go. Another reason why a significant depreciation of the lira is a cause for concern is because it would raise inflation rates, or is because it may lead to cost push inflation. 1. That is the knowledge mark. That's all. Step 2, what do I need to do? I need to now quote the data, right? Well, the data literally says the following. It says, at an annual rate, it's the first sentence. So according to extract A, at an annual rate of 25%, Turkey's inflation is alarming. That's your quote. Third analysis is you now basically say, a depreciation of the currency makes it more expensive for Turkish firms to import their raw materials, and thus the SRAS curve is likely to shift inwards. Now, because we saved so much time, you don't actually need to. You don't got all the marks, but just in case, really quickly, I now want you to draw the diagram with SRAS shifting inwards, and that is cost push inflation. Yeah? And that's it. Yeah? Did I say, by the way, maybe I said demand pull inflation. Some of you are saying, sorry, I meant cost push inflation. Yeah? So they get basically cost push inflation. Well done, Fiscal. Yeah? How many marks have I got so far? I got 6 marks. Did that take 6 minutes? Absolutely no way. 2 marks evaluation. 8 mark evaluations are pathetic. Can I, just to give you examples, yeah? In the June 2017 paper, paper 3, question 2B, it has a figure, 2 figures that you needed to quote, which looked at fiscal deficit and national debt, okay? If you're really stuck and it has data where it has a forecast and it's an 8 marker, I promise you on the mark scheme, it will say the following. It said the data might be inaccurate. The data might actually be wrong, and therefore this may not materialize. But that is lame. That is like if you're really stuck. Here, really simple, you can identify something decent about the fact that their currency is depreciating, which is simply the following, is that they become more price competitive. Turkey become more price competitive, and therefore their exports are likely to go up. And if their exports are going up, I don't need to talk about imports. You could have, but it's 8 marks. It's only 2 marks evaluation. It may result in export-led growth because exports are a component of AD. So AD might shift outwards. That is your evaluation. 2 sentences, nothing more than that. I don't want anything more than that. Maximum 3 sentences, yeah? It doesn't need to be detailed. It's 2 simple marks. 8 out of 8. And now let's deal with one of the dream questions that you might get. One of the dream questions that you may get is the following. So let's see. It's been asked quite a few times, by the way. If you want to revise, by the way, later on, the following papers would be relevant for you. June 2013, Unit 4, question about Brazil. June 2016, also Unit 4, old spec, about Ghana. And the one we're going to do is, well, you could have also done June 2017, by the way, paper 2 in the extract that has an appreciation of the pound. You could also do, by the way, June 2019, paper 2 as well. But that was an 8 marker, so be careful not to like delve into too much detail there. Anyway, the one I want to do is about India, because we're going to do a few questions. We'll segue into something else in a moment. June 2015. Right, let's go. June 2015. Question 4D. If you get this in your exam, I need you to thank whatever deity you believe in, and just, you're so lucky if this comes up. This is the best question that can come up for me. If they ask about exchange rates and the impact of a currency depreciating, appreciating, revaluing, or devaluing, any of them, yeah? This is your go-to analysis. Now, be careful with the wording of the question, because in this one, by the way, it says, assess the possible effects of the fall in the external value of the rupee on the Indian economy. Right. They always do this, by the way, where they throw in terms to try and throw you off. External value of the rupee. Oh, what does external value mean? It just simply means the value of a currency compared to another. What is that? It's exchange rate. In other words, what is the impact of a depreciation of the rupee on the Indian economy? Now, the Brazil question, by the way, in June 2013 was very specific because it was about the impact on the balance of payments. in which case the second part of my analysis becomes a bit void. So for this, know that if it's the Brazil question, only the first part is relevant, the second part is not. But this one's a nice one because it allows me to talk about loads of things. There are what I call trigger points in macro. And if you just know the first chain of reasoning, it opens up a multitude of chains of reasoning for you instantly. And this is our trigger point. Remember how I said to you guys, when it comes to the current account, I want you to always think in terms of China and Germany. Why do people buy Chinese goods? Because they are cheaper, therefore price competitive. Why do they buy German goods? Quality, therefore they are quality competitive. Yeah? If your currency, let's do it in terms of the rupee, has depreciated, are you more or less price competitive in the global market? The correct answer is that you are more price competitive. Your goods become more attractive in the global market because of the fact that they are now cheaper. And now we have the easiest analysis. Because now we go, one impact of a depreciation of the rupee is that it helps to improve India's current account deficit. That's my topic sentence. And now I talk about how it makes them more price competitive. And if they're now more price competitive, what's going to happen to their exports? The demand for their exports are likely to go up. How do I get you guys to get yourself more depth in a 15, a 12, and a 25 marker? It is to ask a very simple question. And the simple question of the exam that I want you to hear repeatedly in the questions like this is to ask yourself, why? So if I said exports have gone up, why? And it's so obvious, but because of the fact that you've answered why in an exam, it gives you the depth needed to get into the top level. So I go, okay, why? Well, it's because now other currencies such as the dollar can buy more rupees. Agreed? So export demand is going to go up because other currencies can now buy more rupees. Imports are likely to go up or down. Imports are likely to go down. Why? Again, the why is because now the rupee doesn't buy as much in the global market. If exports are rising and imports are falling, is the current account deficit shrinking or is it getting bigger? Now, if maths is not your friend, can I recommend you do the following in the exam on a scrap piece of paper? You get a scrap piece of paper. Let's make the following our scrap piece of paper. So I'm going to do it on my board. So imagine I told you that exports, let's do a really easy number, are equal to 400 and imports are equal to, let's say, 900 to start off with. Yeah? Do you guys agree that x minus m is equal to minus 500? Okay. Well, we just said that exports are going up. So let's pick any number bigger than a 400. So let's say 500. And imports are going down. So any number lower than 900, let's say 800. Well, x minus m now is equal to minus 300. Did your current account deficit get bigger or smaller? Well, it got smaller. It's less negative. Yeah? So this is going to basically improve your current account. Is that clear? That is your first analysis. Now, in this type of question, by the way, I would leave a line and jump straight into my second analysis because it leads on from there. X minus m is a component of what? X minus m is a component of AD. And therefore, if X minus m is improving, do you guys agree that aggregate demand is likely to be shifting outwards? True? But on top of it, exports are an injection into the circular flow of income. And so there's likely to be a positive multiplier effect. You can then draw the diagram with AD shifting out. Economic growth goes up. Unemployment goes down. Wow. Analysis, finito. I need you guys to understand the importance of what I'm about to talk about. You need to pay attention to this. If you get a question where the currency has appreciated, depreciated, revalued, or devalued, any of them have happened, and you have done as part of your analysis that the current account is getting better or worse, I obligate you to now evaluate it with the Marshall-Lerner condition. I need the Marshall-Lerner condition to make sense. So let's do it in terms of our question with regards to India, and then I will run you through some maths. It basically says the following. It goes, okay, for there to be an improvement, so for there to be whatever I just said in the analysis, in India's current account, following the depreciation of the rupee, the Marshall-Lerner condition must be satisfied. And then the rule is as follows. This states that the average sum of the price elasticities of imports and exports must be greater than 1, right? Let me make sense of this for you guys, because often this is taught really badly or people are really confused by this, yeah? So basically the PED of exports and imports must be greater than 1, right? Let's understand why this is actually really important and why it makes total sense. When we were dealing with this in theme 2, so kind of like when we were younger and a bit more naive, yeah? If I told you the currency depreciated, you'd simply go, oh, exports go up, imports go down, current account is getting better, right? Okay. But that is very childish. And the reason why is because that is purely looking at it from the perspective of the quantity. Yeah, of course you'll sell more, and of course you'll buy less, but that doesn't mean necessarily that you're going to be making more money or buying less or paying less on your imports. Think of it this way, right? We'll break it up between exports and imports. Imagine I own a shop, yeah? And I told you guys that I sell, let's say, pens or let's say Red Bull cans for a living, yeah? And I decide to reduce the price of the Red Bull can. What happened to the demand for the Red Bull cans? Do you guys agree that obviously demand will go up? Is that fair? But is that enough information for you to tell me whether or not I made more money? Obviously not, right? Because what if I told you I reduced the price of the Red Bull can by 40% and demand went up by 1%? Am I better off or worse off? Well, in that instance, demand is highly inelastic. I am way worse off, right? My price has gone down by 40%. I'm only getting a tiny increase in the amount of customers buying my Red Bull. I therefore am worse off. Is that super clear? Let's make sense of it then in terms of numbers. Now, you will never need to do this. This is more for you to properly understand it, yeah? So let's understand. Wait, hold on. It says I need to refresh my live on TikTok. Yeah, okay, we're back. Right, anyways, right, ready? Let's talk about it. I'm going to make up some numbers, yeah? I'm going to basically say, imagine the PED for exports is minus, let's do a small number, minus 0.7, okay? And let's say the PED for imports is minus 0.8. Right, first things first. My question basically would be this. My question is basically to say, okay, is the marginal learning condition satisfied based on those numbers? Ignoring the minuses, by the way. We ignore minuses when we deal with elasticity. Now, some of you may be saying, yeah, 0.7 plus 0.8, yeah, that's a 1.5. Absolutely not, because it's an average. The average between 0.7 and 0.8 is minus 0.75. Let's use some easy numbers to understand this concept. Imagine initially that we have £1. Let's say it's £1, and we are going to export 100 units to the global market, okay? How much export revenue are we initially making? Well, in very simple terms, we're making £100. Do you guys agree? Yeah? Let's now also say that the value of our imports are also £1, and we are importing 100 units. How much are we spending on our imports? Or do you guys agree that we're spending £100? Right, in other words, x minus m is just equal to 0. Yeah, and it made it really easy for you guys. Okay. And now I told you the pound has depreciated by 10%. There is a 10% depreciation in the pound. Let's plug it into our numbers. So the first thing we need to know is this, okay? Well, the PED for exports, so PED of exports would be equal to percentage change in quantity demanded of exports divided by the percentage change in the price, and that is equal to minus 0.7. Okay. If the pound has depreciated by 10%, do you guys agree that our exports are 10% cheaper? So the bottom of my fraction, so the percentage change in price, I can make it into minus 10. Do we agree? I can now rearrange that. So if I take this minus 10 to the other side of the equation, what do I get? I get that the percentage change in quantity demanded of exports is equal to minus 0.7 times minus 10, which gives me minus 7%. Right, what did I just work out in words? I just worked out that in this particular example, when the pound depreciated by 10%, the demand for exports for our country went up by exactly 7%. Right, let me rub out what I've done over here. And let's work out what that means in numbers. Okay. Now, do you guys agree that when the pound depreciates by 10%, my exports are no longer worth £1? What are they worth? My exports are now worth 10% less. They're worth 90p. Is that fair? And how many units do I export? Well, I just said I get a 7% increase in my export demand. Well, I used to export 100. I chose 100 for you guys on purpose. What's a 7% increase on 100? Obviously 107. But I don't know what that is, right? Someone can do that in the chat for me. So whatever 90 pence, so 0.9 times 107 is, I absolutely 100% guarantee you it's less than £100. Yeah, it has to. What must be? Yeah, 96.3. Well, I'll pass your maths. Thank you very much. What happened to the amount of money that I made? My currency depreciated, right? So you think, oh, wow, my current account surely is going to get better. No, not true, because of the fact that your export earnings are going down, right? Let's do the exact same thing for imports. So now I go, PED of imports is equal to percentage change in quantity demanded of imports over the percentage change in the price of imports. And it's equal to, in my example, minus 0.8. Okay. If the pound is 10% weaker, does that make imports 10% cheaper or 10% more expensive? Would you guys agree that it becomes 10% more expensive? That means the bottom of my fraction is going up by 10%. So it's now plus 10. So I have this. This is plus 10. Let's rearrange it again. If I take it to the other side of the equation, what does that give me? It's going to tell me that the demand for imports are going down by 8%. I'm getting 8% less demand for imports. I'm not going to buy as much. Let's plug it in again and see what happens. Watch this. So now I go, okay, imports. Okay. Do you guys agree, though, that if the currency got weaker by 10%, my imports are 10% more expensive than they used to be? Well, they were £1 before. How much are they now? Do you guys agree that they are now £1.10? So this is £1.10. And I know how many units we now import. We used to import 100 units. And there's an 8% reduction on that. We now import 92 units. How much do we spend on our imports? Again, I'm relying on you guys to give me some accurate maths over here. We're now going to do 1.1 times 92. I guarantee you it will be above £100. It definitely will be. Yeah? Anyone want to do it for me? No one doing it? Whatever that number is. Yeah? Yeah, no one's doing it. Right. Anyway, whatever that number is. 1.1 times 92. That will 100% be above 100. What happened to my current account? Did my current account? Thank you, 101.2. There we go. Thank you. Yeah? 101.2. Okay. Think about what happened to my current account. It used to be 0. X minus M was equal to nothing. It was like balanced. Now, do you guys agree that it's negative? That is the Marshall learning condition in action. In other words, every time you're evaluating the currency appreciating or depreciating, you question whether what you just said happened and talk about the Marshall learning condition. And the best thing about the Marshall learning condition is it comes with like a brother, a sister. They come together, you are going to bring in the J curve. Let's talk about the J curve. And this is how, by the way, I want them combined together. 12 marker, that's it. 10 marker, that's it. It's just these two things combined, they're going to give you the 4 out of 4. Yeah? Even technically, 50 marker, they should get you all 6 marks evaluation. But anyways, let's talk. This is what the J curve is going to show. So we're going to have on the y-axis, so on the y-axis, we have the current account. So here's the current account. And we have positive over here, negative over here. So you'd start in this quadrant if it was like, let's say, China, Japan, Germany, who have a surplus. And then you start over here if you're dealing with a country that has a deficit. Yeah. So over here we have time. Okay. In our question about the rupee, what I want you to start off with is you start basically in the section where they are in the deficit. So we're going to go over here and I'm going to go across. Yeah. And imagine initially nothing has happened. Yeah. The way to work out the shape of this curve is to go to yourself, okay, whatever I have just said in my analysis, the opposite will first happen, and then what I said will happen. In other words, in our analysis, when the rupee depreciated, we said that the current account will get better. In other words, when I draw this, initially, it will get worse. Those of you that are on TikTok, by the way, if you want to see my diagrams, go on YouTube. On YouTube, I'm showing my screen. You can see everything there. Yeah? So I go, okay, I said it would get better. It's going to get worse first. And we'll talk about why in a second. So it goes down, and then it goes up, which is why it's called the J curve. Yeah? Looks like a J. That exact moment in time, by the way, on that diagram, is the moment in which the rupee depreciated. Okay? That is the moment the rupee depreciated. I don't know if I'm spelling the rupee right, but whatever. Okay, let's understand why. First and first, if your current account is literally getting worse on the back of a depreciation, does that indicate the Marshall learning condition is or is not being satisfied? Do you guys agree that it suggests that it's not being satisfied? Yeah? But the why is it not being satisfied? That means that exports and imports are inelastic. Why are they inelastic? There's one main reason why. There are two, but there's one main reason. Firms are tied into trade contracts. Firms cannot significantly increase how much they export, and they cannot significantly decrease how much they import because they're in a contract. And therefore, in the short run, the current account will get worse. In the long run, eventually the contracts get renegotiated, blah, 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 and the current account now starts to get better. And that is fire. That is a wow evaluation. If it were an appreciation, by the way, can I just show you guys what an appreciation would look like? So my analysis for an appreciation, I'd be saying, oh, less price competitive, exports down, justify why, imports up, current account will get worse, yeah? Okay, if I was doing it as an appreciation, I would do it like this. So let's say the question is about an appreciation of whatever currency. Let's do the rupee again, yeah? I would do it like this. So I'm just undoing it. All right, there we go. So I go, okay, we start off them having a deficit. Now, if they have a surplus, obviously start in a surplus, yeah? And then remember what I said you guys do. You go, okay, whatever I've just said, the opposite happens. Whatever I said in the analysis, the opposite now happens. So I just said that the current account is going to get worse. Well, initially it's going to get better. So it's going to go up, and then eventually it will go down, like that, yeah? Just describe that, by the way, as like the curve rather than like an inverse J curve, yeah? Is that clear? This is being recorded, by the way, and it will be on YouTube. You can watch it back later. Yeah? Happy? Easy? That is our analysis. That is our evaluation. That is our dream question. If it comes up, happy days for all of us. Let's go to a new topic. Right. 12 marker. Could be something along the lines of, is a large trade deficit a cause for concern? That, and then I want to fix it. I want to talk about whether it's a cause for concern, and I want to fix it. So let's start with whether it's a cause for concern. Can I just lay out how you answer this? You can write this in bullet points. You can watch this back later, just so I can get through a lot of stuff. I want to get through development. I want to get through the financial sector as well. Let's start with the following. Is it a cause for concern? Well, the easiest way to understand this, and this is for basically all examples, by the way. So this particular topic, if they ask you whether a large or persistent trade deficit is a cause for concern, your starting point is to go, X minus M is a component of what? Well, do you agree that X minus M is a component of aggregate demand? Yeah? Therefore, if you have a deficit, either X is falling or M is rising or both, and therefore AD might be shifting inwards. And on top of it, by the way, imports are a leakage, the withdrawal from the circular flow of income, and so it may lead to a negative multiplier effect. Yeah? So this is the number of times the fall in national incomes is going to exceed the initial leakage that caused it. Sorry, just moving charge around. So you shift AD inwards. You guys agree that that causes economic growth to go down? And you agree it causes unemployment to go up? Is it a cause for concern? Yeah, it's a cause for concern. That is our first analysis, yeah? Eval. The evaluation, you can do a few things. One of the things you could talk about is to talk about, well, it depends, because it depends on where the economy actually is. If the economy is at full capacity, for example, and the AD curve shifts inwards, not necessarily a cause for concern, because you get disinflation, but there's a much better evaluation. The really clever evaluation is as follows. The example I want you guys to remember is the USA. The USA have a massive trade deficit. Is it a cause for concern? The reason why it's not a cause for concern is because actually it's a sign of economic prosperity. Think of it this way. If I earn more money, I will spend more in the UK, true? But me spending in the UK doesn't impact the current account, it impacts consumption. But do you guys agree that I'll also buy more stuff from abroad? How do I buy more things from abroad? Well, I basically will import them. Therefore, imports are rising. In other words, if you have a scenario where economic growth is occurring in an economy, that could translate into more demand for imports, in which case it is not really a cause for concern. Perfectly fine. That's great. First analysis, first evaluation. Second analysis, is it a cause for concern? Okay, remember how I said to you guys that if you get a question about like the causes of a trade deficit, well, you're simply thinking of it in terms of China, Germany. You're either not price competitive or you're not quality competitive. In other words, why would the UK, for example, be less price competitive than China? One, we have a minimum wage. Two, our productivity levels may not be as high. Three, it could be that the infrastructure and the economy is not as good. It could be because like all these reasons, right? The point then is going to be this. If you have a persistent deficit, that would suggest that you may have a structural weakness within your economy. Your economy, something is fundamentally wrong with it. That is the cause for concern. It might indicate that inflation in your economy is too high. It might indicate that your education and training standards are low compared to other countries. You're basically developing it in that way and talking about it is a cause for concern because it indicates a structural weakness within the economy. And then we can do a wow evaluation. And the wow evaluation to this is to say something along the lines of, well, it depends. Because if the deficit is predominantly caused by a country importing capital, machinery, and technology, then in the long run, they're going to become a net exporter potentially. If a developing country, as an example, is starting to import more capital, do you guys agree that that will allow them to develop sectors like manufacturing? Do you guys agree that it will allow them to improve their technology? A, that will reduce their cost of production, and B, it will result in them becoming more price and quality competitive. Therefore, actually, in the long run, they might start to experience economic growth, and their current account might start to improve as well. Easy? Let's go. Last question I want to do on the current account, exchange rates, all of that, is a potential 25 marker. 25 marker could say something along the lines of this. Are you ready? Some water. Let's breathe. Right, I don't know how tired you guys are, but talking nonstop is very tiring. Let's go, though. Let's go. 25 marker says this. Evaluate strategies that could be used to correct a trade deficit. 25 marks. Let's deal with it. Evaluate strategies that could be used to correct a trade deficit. Right. Bear in mind, in a 25 marker, I only want you guys to do 2 analyses and 2 evaluations, but in detail, yeah? I am going, for the purpose of kind of being like including everything, going to do 3 and 3, yeah? But bear in mind, you only choose 2. Number 1. Again, let us remember a few things. if I want to improve my current account, I either need to become more price competitive or I need to become more quality competitive. It's as simple as that. How do I become more price competitive? What do I need to do to my exchange rate? Would you guys agree that I need to devalue my currency? I need to make it weaker. And I can do this in one of two ways. Either I go through the foreign exchange market, and I think that's the better route, by the way, or I could talk about interest rates. Now, be careful with this particular point, by the way, because of the fact that if it's like a country in the Eurozone, it's not up to them to do this. Like there's one central bank in the Eurozone, yeah? So therefore, realistically, you're not going to be able to do this for like a Eurozone country. But if it's like, let's say, a developing economy, let's say it's I don't know, Brazil, whoever, yeah? Let's do Brazil, actually, as our example, yeah? We start with the following and go, one way in which Brazil can reduce their trade deficit is by devaluing the real. And notice, by the way, that I use the word devalue rather than depreciate. Why? Devalue is where you purposely manipulate your currency to make it weaker. Depreciation is through pure like supply and demand. It's free market. It's floating. The question then is this, and this is a revision for what we did earlier. How do I devalue my currency? And the mark scheme is clear, by the way, on this. It says, listen, if this is going to be asked and we basically get you to do devaluation, you are obligated to explain the mechanism by which they do this. How do they do this? Well, basically, they're going to, are they buying real or selling real? They are selling real. If they sell real, they must be buying the other thing. They are buying foreign reserves. Yeah. You now draw the diagram, by the way. So I'll quickly draw it on my board. So we're going to have this. So we're going to have price of real in, let's say, dollars, and the quantity of real. Okay. And we just have simple supply and demand. Here's supply, S1, D1, Q1, P1. And remember, what I want to do, I want to make my currency weaker, yeah? So if there are suddenly more sellers of the real, in other words, the central bank is selling loads of real, what that does is that means that the supply is shifting outwards. There are more sellers in the market. Supply, therefore, shifts outwards. And what does it do to my currency? It does exactly what I wanted it to do, which is it makes the currency weaker. In other words, it devalues it. And from here, easy peasy, because now we have a trigger. And the trigger is if the currency has devalued, what does it make Brazil? It makes Brazil more price competitive. And if it makes Brazil more price competitive, what happens to their export? Their exports go up. And remember what I am screaming in your head in the exam to give you depth. 15 marker, 25 marker, you hear me in the exam going, why? Why did you just say that happened? Because if you tell me why, it gives you an extra chain of reasoning. You go, exports go up. Why? Because other currencies can now buy more real. Imports go down. Why? Because the real cannot buy as much in the global market now. And that is your analysis. Exports up, imports down, current account deficit shrinks. Have we corrected the trade deficit? Yeah, we corrected the trade deficit. Make sense? Let's evaluate. You should know what the evaluation is. The evaluation has to be Marshall Lerner, J-curve. You're welcome. Yeah? Marshall Lerner, J-curve. Finito. Go. Let's go. That's our first analysis and first evaluation. Done. Second analysis. Now, I would do this one because it's so straightforward. If I were you guys, I would now talk about supply side policies. If you're lucky, by the way, your 15 marker or 25 marker could literally be about supply side policies. Honestly, if it's your supply side policy, like you get that, you're so lucky. If I were you, by the way, I would do the June 2015 paper about India, 15 marker there, easy. Anyways, supply side policies, the one that I always want you to do, because it's so easy, is investment into education and training. Let's talk about education and training. There are several key buzzwords that I need you guys to be able to churn out in an exam to show off. If I invest into education and training, do you guys agree that realistically that makes my workforce more productive? That raises the level of what's called human capital. Yeah, so the first buzzword is going to be human capital. Human capital is basically like, if you think of workers as like machines, how much output does the worker produce? That is their level of human capital. So human capital is going to go up, fair? The other thing that we can talk about, which is really useful, is unit labor costs. Right. What are unit labor costs? Unit labor cost is the cost of each worker relative to the output that worker produces. Right, let me make sense of this with a made-up example. Imagine I have a worker that I pay £1 and they produce 1 unit. I then get another worker who I pay £100 and that worker produces 10,000 units. Who has a lower unit labor cost, number 1 or number 2? The answer is number 2. Because although number 2 is getting a higher wage, they're producing so much output that the cost per unit is lower. The June 2012 paper, Unit 4, has a question about the Eurozone, and it compares the unit labor costs of several Eurozone countries. The highest unit labor cost, if I remember correctly, was Spain. The lowest was Germany. Does that mean that German workers get paid less than Spanish workers? No. It just means that despite the fact that German workers get paid more, they are so much more efficient than Spanish workers that the cost per unit is lower. Anyways, that's another buzzword. Talk about unit labor costs going down. You can also talk about how a more educated workforce is more likely to come up with technological innovation. It's more likely to come up with like, breakthroughs and I don't know, like new discoveries. And then we bring a basic diagram into the equation. And that basic diagram is the LRAS curve shifting outwards because this is supply side policy, right? So let's do it. Real GDP over here and price level over here. Here's my initial LRAS curve, LRAS1, AD1, Y1, P1. LRAS is going to shift outwards, right? As a result, look at what happens. Two things happen. One is you get growth, great. But something else happens. You also get disinflation. How's that helpful? My question is very helpful. The reason why it's so helpful is because of the fact that now you've also got disinflation. You are now both price competitive and quality competitive. That is beautiful analysis. Absolutely like beautiful. Evaluation. There's an easy evaluation that's always on the marks team that especially if you're running out of time, this is your go-to here, time lag. It takes ages for individuals to pass through the education system and begin impacting the economy. Yeah. As a result, do you get it? You basically go that if they are, going through this process, it's going to take like a whole generation for individuals to actually get to the point where they impact the economy. Think about you guys. So most of you watching this stream are probably 16, 17 or 18. Yeah. Maybe 19 if you're retaking it for the second time. It's okay. Don't worry, we'll get you through this time. Maybe 20. Who knows, right? You basically go, listen, it's going to take like a whole generation for individuals to pass through the education system and start impacting the economy. This is not in any way a quick fix. Yeah. Is that super duper clear? Yeah. That is our evaluation. Now, can I give you guys one alternative evaluation where we can show off a little bit? That is brilliant, by the way, and I love that and I don't mind it. Do you agree that in order for the government to actually have an impact, they're going to have to spend a lot of money? Now, some of you, because I'm not going to lie to you, before this stream, maybe you're a bit basic, yeah? We're in here to do basic points. Some of you might be saying, oh, opportunity cost. Get out of my face, opportunity cost. Opportunity cost, are you joking? We're not babies anymore. We are going to do a much more sophisticated point, which is this, which is you now say if the government is spending more money, the fiscal deficit is going to go up, the national debt is going to go up, their credit rating might go down. And if their credit rating gets downgraded, what happens to the demand for their government bonds? Well, the demand for their government bonds will go down. If the demand for their bonds goes down, what happens to the price of their bonds? The price of their bonds goes down. As a result, the interest on their bonds, fancy way is their their yield on their bonds, just basically the interest rate on their bonds goes up. Is it easier or harder for that government to now service their debts? Harder. Wow, evaluation. Yeah. But bear in mind, by the way, time lag works just as well, and it's amazing. And it's one of those where you could do very quickly if you're running out of time in the exam. Easy. That is the essay done, by the way. If I had a choice, those are my points. Can I give you one last analysis, though? Because it allows me to quickly deal with another topic as well. Another way that you can basically fix your trade deficit is through what we call expenditure switching policies. Expenditure switching policies is a fancy way of saying something that you all know about. It simply means protectionism. Impose protectionist policies. And now you have a choice, by the way, in terms of which protectionist policies you want to talk about. There are three main protectionist policies that you guys need to know about. One, tariffs. A tariff is a tax on imports. Cool. Quotas. A quota is an upper limit on the number of units you allow to come into your country. And number three are domestic subsidies. Subsidies are protectionist policies, by the way, because they give your firms an unfair advantage because they become more price competitive. If I subsidize my firms, do you guys agree that their cost of production go down? Their prices, therefore, also go down. As a result, they become more price competitive. But they're only more price competitive because I've subsidized them, hence why it's seen as protectionism. Easy? Okay, let's deal with the analysis. The one I would do, by the way, is probably subsidies, just because of the fact that I could do both exports and imports, but I don't mind. You could have done it as a tariff, you could have done it as a quota, no problemo, yeah? So our analysis could be something along the lines of another way in which Brazil or whichever country can reduce their trade deficit by imposing or by using expenditure reducing policies, yeah? And then you explain that this is protectionism and give an example of something like subsidies. Now, subsidies is easy. You basically talk about how this makes your firms more price competitive. Exports therefore go up. Again, what am I about to ask you? Obviously, I'm about to ask you why. Why do exports go up? Exports go up because you're more attractive. Your goods are cheaper, therefore you are more attractive in the global market. Imports go down. Again, why? Because people in your economy go, why am I buying expensive stuff from abroad when things in my economy are cheaper? So they import less. X up, M down. Current account deficit shrinks. Does that answer my question? Yes, it answers my question. That is the analysis, and the evaluation is really straightforward. I can do one of two things. The better evaluation, I think, for this particular question, by the way, is basically to talk about how it might instigate a trade war. Yeah? That other countries might retaliate and be like, what the hell are you doing? No. Yeah? Example. In the lock specimen paper, paper 2 for Edexcel, it has an extract about how the Chinese government were accused of subsidizing the telecommunications sector, basically mobiles and whatnot. And in retaliation, the EU was about to impose a hefty tariff. Why? Because of the fact that basically they go, this is unfair. You're giving an advantage to your Chinese firms at the expense of our European firms. We're going to place a tariff on you to make it more expensive for Chinese firms to sell into the EU. If that happens then and you engage in a trade war, your current account might not get better. It might get worse. What matters at that point, by the way, is the elasticity of demand for your exports and imports. Because if suddenly you get, let's say the demand for my exports are price elastic. In other words, people proper don't care about my exports. Do you guys agree that what ends up happening is that if I have a tariff placed on me, my demand is dramatically falling. My export earnings are going down. They're on the floor. They are, I think what you guys call it, I'm cooked. Yeah, I'm cooked. Is that what it is? Yeah. And on the other hand, imports are now, do you get it? If my imports, let's say, are inelastic, well, realistic, my consumers are addicted to your product. As a result, what happens? I'm going to import only a little bit less. My current account is not getting better. My current account is getting worse. That is a great eval. But, and now, by the way, that's the essay. Yeah. But can I now just show you one thing before we move on? One of, if not the best diagram in the whole of macro, in my opinion, probably in the whole of the A-level, is the tariff diagram. If you are not on YouTube, by the way, I highly recommend you go on YouTube now, because I'm going to show you step by step what the diagram looks like. Let's talk about the tariff diagram. This is how you draw it. So here is the following. So we're going to have quantity, price. Yeah. Our starting point is simply supply and demand. Yeah. So this is supply, but the only difference now is that we would normally write domestic over here. But here, if I know what country it is that's imposing the tariff, I want you to write the name of the country. Example, in the question about the EU versus China, it was the EU imposing a tariff. So I'd write SEU. If it was, let's say, the 2021 paper, or I think it's the 2021 paper, one of the COVID years, it was Rwanda imposing a tariff on secondhand clothing, you write Rwanda, whatever, right? So here, let's do it from the perspective of, let's say, Brazil. Yeah, so this is Brazil. In other words, these are all of the firms, the farmers, producers, whoever they are, selling this good in Brazil. And then this is the demand, again, in Brazil. Right. For this particular diagram, by the way, I do not want you to label the initial equilibrium, that point there, because that would only be the equilibrium if it was a closed economy, which means that there's no trade whatsoever, which is unrealistic and not likely to be the case in any circumstance. So ignore the equilibrium here, yeah? What you're instead going to do is you're going to go, okay, we're going to set a world price and call it WP1. So I'm going to call WP1 and I'm going to put it down here somewhere. Yeah. Make sure, by the way, it has to be below the equilibrium. There is a reason why. Just accept it for now. Your exam is in 2 days. Yeah. It's below the equilibrium. And we assume in this market or in this diagram, we assume that firms become price takers. Imagine that you could get this product from anywhere around the world. Therefore, no one can charge a higher price than anyone else, because if they did, no one would buy it off them. They buy it for the cheaper price. So whatever the world price is, you have no choice but to sell it at that price. So go. We got WP1 is this, and therefore world supply is perfectly elastic. This is world supply. Okay. And the reason why it's perfectly elastic is to assume essentially that at that price you could get it at from anywhere in the world. Okay. There is a very important exercise that you now need to now follow. Step one. The first thing that you need to do is you go, okay, world price hits which curve over there? What curve is that? Do you guys agree that that is the supply? My question to you then is this. Is quantity supplied high or low in this particular market? Well, the supply is very low. Why is it low though? It needs to make sense intuitively. It needs to make sense logically. The reason why supply is low is because the supply curve maps out at different prices how many units you're willing to sell. True? Well, if you think about it, For Brazilian firms, based on their supply schedule over here, this is not a particularly attractive price. This price kind of sucks. They go, not really interested. I'll make a bit, but I'm not going to make very much of this because it's not worth my while. Demand, on the other hand, is all the way over here. And again, the question, very simple. Why? Why is demand so high? Why are people in Brazil buying so much of this good? Well, the answer is simple. It's super cheap. Therefore, they go, I want loads of this. Therefore, if we think of it in terms of numbers, by the way, to make kind of make sense of this, imagine this number was 100 and this number was 400. So I'm now a Brazilian, yeah? And I decide, you know what? I want 400 units of this good, but there are only 100 units being produced by firms in Brazil. Where do I need to buy my products from? I can only buy 100 domestically, but there's another 300 that I want to buy. Where do I buy it from? Do you guys agree that I need to buy it from abroad? And if I buy something from abroad, what does that mean? That means the distance between Q1 and Q2 is the level of imports. And that is why it is the imports, by the way. It is M1, which represents imports because of the fact that if the demand in my economy exceeds the supply, I need to be buying it from abroad. Easy. Let's now do the following. We go, okay, now the government impose a tariff. What is a tariff? The tariff is a tax on imports, meaning that everything now coming into the economy is being taxed by a certain amount. So we now raise the world price by the tariff. So we're going to go WP2, yeah? So now we go, here is the world supply plus the tariff. So WS plus tariff. Right, same exercise again. What does it hit now? It hits supply over here. This is Q3. All right, I have a very basic question for you guys. Has the supply domestically gone up or down? Do we all agree the supply has gone up from Q1 to Q3? And why? It has to make sense logically. And the reason why it makes sense logically is because of the fact that this higher price attracts more suppliers to produce the good. They go, oh, you know what? It's a higher price. Bear in mind, Brazilian firms are not paying a tariff. But because of the fact that the price has now gone up, let's say it was £5 or 5 real before, and now it's 6 real, they go, oh, you know what? That's 6 real. I basically now will increase how much I supply from Q1 to Q3. Cool? On the other hand, demand is now over here, Q4. Has domestic demand gone up or gone down? Demand has gone down. Why? Again, it has to make sense logically. It's gone down because consumers don't want to buy as much at the higher price. They can't afford as much. Therefore, the distance between Q3 and Q4 represents the new level of imports. That is M2. Imports have gone down. Yeah? Does that make sense? That is M1 and M2. Let's go. But we're not finished yet. What we can now do is as follows. You basically go A, B, C, D. There are 3 players in any economy. And if you know how to analyze each of them, you could use it for analysis, you could use it for evaluation, and you could use it to become a monster. Let's become monsters. Are you ready? The 3 players in any economy are consumers, producers, and the government. Theme 1, throwback to like one of the early phases in theme 1. I don't know when you guys got taught this, but hopefully quite early on. Consumer surplus. I'm going to squeeze it in at the bottom here. What is the definition of consumer surplus? Consumer surplus is the difference between the maximum price a consumer is willing and able to pay for a good and the actual price they pay for the good. Agreed? Let's work out what's happened to consumer surplus. And the way we do that is through what I call like a 3-step process. If you guys follow this 3-step process, you'll always be able to work out the area for consumer surplus. Let's go. Step 1 is to go, okay, which curve is about the consumer, the supply curve or the demand curve? Do you guys agree that the demand curve is the consumer, yeah? So let's see where the maximum price consumers are willing and able to pay for the good. Well, do you guys agree that where the demand curve hits the axes, can you see that point over there where my red dot is? That is the maximum price the consumer is willing and able to pay for the good. Okay, second question, second dot. Second dot is, what is the actual price the consumers pay for the good? Well, initially, the price they pay for the good is WP1. Do you agree? Over here. So that's my second dot. And then I go across from that price until I hit the demand curve because that's the number of units consumers are buying at that price. There. Can you guys see my 3 dots? So it was there, to there, to there. Okay, let's do the exact same process now with the new world price. The starting point is the maximum price consumers are willing and able to pay for the good. Has it changed? Well, no, it hasn't changed. It's still there. The demand curve hasn't shifted. But what has changed? What has changed is the world price has gone up to WP2. So WP2 is there. That's my second dot. I go across from that point and I go to the demand curve there. Look at what happened to consumer surplus. It used to be where the dots are. It is now where my squares are. Consumer surplus, do you guys see, has gone down by A, B, C, and D. The consumers get mashed up. They are obliterated here. Consumer surplus is minus A, minus B, minus C, minus D. It is an absolute calamity for consumers. Yeah? Let's deal with the producer. So I'm just going to do PS for producer surplus. Okay, let's do it. Yeah? Producer surplus is the difference between the minimum price the producer is willing to sell the good for and the actual price they sell. Okay, let's deal. So the first thing we go is, okay, the minimum price the producers are willing to sell it for, where is that? Well, it's where the supply curve hits the axes, here. So I'm going to do that like a triangle. Agreed? What is the actual price that they pay for initially or get paid for? They get it for WP1. That's my second point. And then I go across until I hit the supply curve. So that little area there, you see that point there? That is the initial surplus area for producers. Yeah? Then let's deal with it in terms of the new price. So we go, okay, the minimum price they're willing to sell it for. The minimum price is still there. It hasn't changed, right? So that's still my point. I'm going to do it as a big circle. Yeah? But what has changed is the price they now get. The price they're now getting is going to basically be WP2 here. Yeah? And then you go across until you hit the supply curve. The producer surplus goes up by A. Yeah? Just so you guys know, I am reading comments, just kind of not ignoring you guys, but just whizzing through as much as I can, making it as useful as I possibly can for you guys, being selective about the questions that I'm answering. So just go with me. Yeah? Like, we're going to get through as much as we can before your exam. Are we clear? Producer surplus has gone up by A. Consumer surplus down by A, B, C, D. Producer surplus is up by A. Right, last one is government tax revenue. Right, is GTR. Whenever there's a tax, do you guys agree that the government collect tax revenue? And there are two things that I need to tell you to determine how much tax revenue the government make from any tax. The first thing I need to know is how many units are taxed. And the second is, what is the tax rate? Well, here, what is a tariff? A tariff is a tax on imports. So the two things I need to know is, what is the tariff? And two is, I need to know how many units are imported post-tariff. In other words, once they impose the tariff. You guys agree the distance between Q3 and Q4 on my diagram, that width is the level of imports. The height, that is the tax, that is the tariff, that is the tax per unit. So what is the area? The area that the government generate tax revenue on is equal to plus C. That is the government tax revenue. And if you now want to talk about this, you can talk about the net effect, or you can just focus on the negative impact on consumers as evaluation for protectionism. You can say how consumers are so much worse off. Their consumer surplus goes down by A, B, C, D. You can also talk about how there's overall a welfare loss. Think about why minus A and plus A cancel. Minus C and plus C cancel. You are left with two welfare loss triangles of B and D, because consumers in your economy now not only get less choice, they face higher prices, but inefficient domestic firms who would not have survived under free trade are now kept in the market, and that is a big problemo. Is that clear? Right. I need water, and then we're going to move on to the new topic. Your heading in your notes, please, is economic development. Actually, financial sector first. The heading, please, is financial sector. Let's deal with that. Right, let's go. The financial sector is one of the new topics, and because of that, it scares people, and I get why. There are two things you need to know about the financial sector. One is the role of the financial sector, and two, the harder question, is market failure in the financial sector. Now, that second question, I have written out a 25 marker for you guys. I did it as a paper 3 question, but you can very easily take the points and make them more macro. Yeah, that will be posted on our Instagram page tomorrow. Yeah, potentially tonight. Literally read my essay. Yeah, it will go through all of it for you guys. I'll also link a video that I think is unbelievable at explaining the financial crash. But before that, let's deal with the role of the financial sector, and there are 5 roles. There are 5 roles the financial sector plays that you need to know. Let's write them out. One is it facilitates savings, makes it easier for individuals like you and I to save our money and then access that money at a later date. 1. Number 2, it facilitates lending. Do you guys agree that we can borrow money from the bank, like, for example, HSBC, and then we can use that for investment or whatever it is, yeah? So if a firm, they would invest. If an individual, you can use it for, like, to purchase goods and services. Number 3, to facilitate the exchange of goods and services. Okay. Number 4, to provide something called forward markets. And finally, number 5, so that's number 4. Finally, number 5 is that it provides a market for something called equities. Right. Let's talk about what equities are. Equities, by the way, we'll talk about forward markets in a second. Equities are stocks and shares. So companies can give away a slice of the company in return for money. So they can use that to like grow, invest. But as an investor, you might want to buy shares in a company because if the company does well, you might get paid dividends. Or if it does well, the price of the stock might go up. And so you could sell it for a profit. Anyways, is that clear? Right. Those are the 5 different things that you basically want to know and understand in terms of the financial sector. I want to take you guys through what I regard as probably one of the hardest questions they have asked so far on the financial sector in June 2019. And then we're going to combine the financial sector with June 2018, where it combines it with economic development. Let's do it. Right. Let's share screen and show you guys the question. Right. Paper 2, June 2019. 1 second. No, my laptop is very old, and so it is lagging. Right, let's see. Here we go. So, and this is the question that I want us to deal with. I actually want to deal with this in terms of economic exam strategy as much as anything else. Yeah, it is live on YouTube. Yeah, right. The 15 marker is the following. So if you're on TikTok, I highly advise you guys move over to YouTube because you can see my screen. Yeah, the 15 marker says this. It says, discuss whether providing substantial government financial support to banks is the best policy response during a financial crisis. This is awkward as hell. This is not an easy question to deal with. Can I make your life so much easier? And the way I'm going to make your life so much easier is by turning the question like amending the question a little bit. If you get a question about whether it's relevant for the government to intervene in the way they have, what you can do is you can go, okay, let's assume they hadn't intervened. Let's assume they left it and allowed the banks to collapse. They allowed the banks to go bankrupt. What would have happened? We'll talk about what will happen in a second. And then as a result of saying how catastrophic that would be, the ending of the paragraph would be like, yeah, they probably should bail them out because like we don't want that to happen. Make sense? Let's start with our first analysis, yeah? I'm going to do this out loud. You can watch it back later. You can plan it later. You can write the whole essay later just to get through it quickly. Our starting point is to say this. If commercial banks, such as Northern Rock, Lloyds, and RBS, the extract helps you with this, by the way, but you should also know that from real world knowledge, were allowed to go bankrupt, savers would have lost their money. Imagine you and I, the money that we have in our account, suddenly it's gone bye-bye. It actually alludes to this in the data, by the way. It says there was no mechanism in place because savers could lose all their money. It's actually, where is it? I'll show you. Yeah. Here we go. This has not been possible in the past because of the risk that savers lose their money and because the system did not exist to allow banks to be put into insolvency. Insolvency basically means they can go bankrupt. Anyways, savers lose their money, right? If you lose your money, what happens to your level of consumption? You guys agree that realistically, you're going to dramatically reduce your consumption. That is already a problem. But we can now add some real world knowledge to this. The financial crash. One of the big causes of the financial crash was house prices were going down like mad. House prices going down results in a negative wealth effect. Consumer confidence then, was it high or low? Do you guys agree that consumer confidence was on the floor? And if consumer confidence was really, really low, and on top of it, now savers lose their money, consumption is not just falling a little bit, by the way. Consumption is in absolute free fall. Your economy is falling not into just a recession, by the way. It could genuinely be falling into something called a depression. That is so, so bad. It's going to result in major negative growth. In other words, should the government step in and bail out the banks? Yeah, they should, because we don't want that to happen. That's your first analysis. Does that make sense what I just did? I basically went through the scenario of when they basically didn't bail them out and go, oh my God, they need to bail them out. That's the analysis. Let's evaluate. The best evaluation is through a concept known as moral hazard. And you can use moral hazard whenever there's any form of debt relief or something like this, a bailout. Moral hazard is the idea that basically the government stepping in and bailing out the banks creates this idea in the bank's head that they are going to get bailed out again in the future. They basically think, oh, they let us off. Okay, cool. If we basically incur like really high levels of debt and we, take on crazy levels of risk, fine. The government are going to basically save us. They're going to step in and save the day. Therefore, these banks may in the future start to take really risky like strategies, knowing that the government will have to save them because of the fact that there's a massive moral hazard here. If you guys got a question about debt relief for like a developing country, moral hazard. Moral hazard because of the idea that they get debt relief and there becomes an expectation they're going to get it again. So they start accumulating high levels of debt again. That's the first half of the essay. Let's deal with the second half of the essay. Second half of the essay is in relation to firms. Do you guys agree that firms also put their money in banks? Businesses, like expatriation, we put our money in the bank. If the bank turn around and go, oh yeah, you know your money, sorry, it's gone, your money's gone. What happens to businesses? Do you agree that loads of businesses are going to now shut down? If firms are shutting down, are they hiring or firing? Obviously, they're firing. Unemployment is going up. But by the way, unemployment goes up in the first phase because the banks themselves employ people. So if the banks collapse, Northern Rock, Lloyd's, etc., unemployment goes up in that sector. But on top of that, they then have a spillover effect. There's an externality here. Yeah, one of the market failures in the financial sector, by the way, is externalities. This is an externality. The bank mismanaging its affairs doesn't just impact the bank. It will impact all the firms that bank with the bank. They put their money there. And now suddenly firms are going bust. Firms going bust, higher unemployment, but also now firms, when it comes to borrowing money for investments, are they able to borrow money if there are no banks or if there are very few banks? One, it's harder for you to borrow money. Two, if you find a bank that will allow you to basically borrow money off you, do you guys agree the interest rate you're going to have to pay is going to go up? The cost of borrowing for firms goes up, the level of investment therefore goes down, and it is again bad. That is your second analysis. Second eval, we have done it already. And strategically, I did that before this point here. Tell me what you do now. Was it cheap for the government to bail out the banks? No. The government needed £65 billion, by the way, and that was just Lloyd's and RBS, yeah? If you look at data, by the way, June 2017, paper 3, question 2B, look at it later on, yeah? It has data to show you the national debt as a proportion of GDP in the UK. 2007, the UK's debt as a proportion of GDP was about 35%. Fast forward to the year 2009, and it's gone up to 70%. That is, or was it, I think, sorry, 60%. That is a mental rise, by the way, yeah? It is now currently about 100%. That is wild, yeah? What can I now bring in? I could talk about how high fiscal deficit, high national debt, downgrade in your credit rating. Downgrade in your credit rating, less demand for bonds, lower price for government bonds in the UK, which are called gilts, by the way, if you want to show off. But only UK bonds are called gilts, so only the UK ones you do that for. Higher yield, the interest rate goes up. Is it easier or harder for the UK government to service their debts? It is harder for them to service their debts. And that is 15 out of 15 comfortably. Let's go and do the June 2018 paper. How are we feeling? Are you guys all right? How long have we gone for? We've been going for about 2 hours nearly. Right. Let's do it. 15 marker here. Honestly, I think this is quite challenging, but hopefully once we go through it, it'll be straightforward. It says the following. Discuss the role of the financial sector in the growth and development of developing countries. That allows us to basically do some revision on economic development as well. Let's start off by defining economic development. In order for you guys to understand economic development, or for you to define economic development, you should actually begin by defining economic growth. Economic growth, which all of you hopefully should know from theme 2, is basically just a rise in real GDP. So you start off with that. You go, economic growth is a rise in real GDP. Nice and easy. I would always start with economic growth, by the way, before I define economic development, even if the question is just about economic development. And you go, economic development seeks to also factor in non-monetary factors such as education, healthcare, and infrastructure. So like, if you think about it, GDP is a purely monetary factor. It's purely quantitative. Whereas this is like qualitative factors as well, yeah? And the thing that I really want you to talk about is basically that, what's it called? HDI. Talk about HDI. You talk about how basically HDI is a good metric to basically determine the level of development. And it's made up of 3 parts. You don't need to talk about this in this question, by the way, but you need to know. So there's living standards, which are measured by GNI per capita at PPP rates. It's education rates and healthcare. Within them, there are subcategories, but like generally education, healthcare, and then living standards through GNI per capita. Okay. What I would do for a question like this, so it basically says, how can the financial sector help promote economic development? What I would now do is as follows. I would go, okay, I know the 5 roles of the financial sector, which I did with you guys on purpose. What I therefore need to do is work out what are the limitations to growth and development? What are the constraints? What are the problems that developing countries face? And then we can start matching them. And this is where we now revise. So this is financial sector. So you should be able to see my board. And this is limitations to development. Right. There are like 8, 9 different limitations to development that you guys need to know, yeah? I'll go through the main theoretical ones, starting with number one. Number one is called Paredomar savings gap. I'll talk about what that means in a sec. In fact, you know what? Let's start with that. Let's start with the savings gap, yeah? So the savings gap basically works in the following way. In many developing countries, the savings rate tends to be very, very low. And the reason why their savings are very low is because their GDP per capita, so the average earnings of someone in that economy, is typically very, very low. Therefore, they have a very high marginal propensity to consume. Right, let's make sense of what that word means. It means that for every additional unit of income they earn, how much of it do they spend on like goods and services? Well, in these economies, the MPC is very high. Think about why. If I make $10 a day, do you guys agree that realistically, I'm going to spend pretty much all my money on basic necessities like food, water, and clothing? True? Am I therefore saving? Well, no, not really, because my income is so low. So the first thing you go is, look, savings rate is very low because of the fact that GDP per capita is very low, and therefore they basically don't save because they spend most of it on necessities. To make matters worse, the financial sector is very underdeveloped in these countries. And one of the main reasons why is that banks lack the profit incentive to set up in countries where savings are low. Why would I, as a bank, go to a country where no one is saving? How do I make my money? Make sense? So basically go, okay, savings are low, and as a result, the banking sector is underdeveloped. So in other words, even if someone wanted to save money, imagine you had to walk 10 miles to get to a bank. Are you likely to do that on a regular basis? Well, obviously no. Yeah. So you're not going to save. Now, why are savings important? The reason why savings are important is because if banks have money in their accounts, they can lend to firms in that country. And those firms borrowing more money and hopefully at lower interest rates allows them to invest into capital machinery. And investment is crucial for long-term growth and development. And the reason why is this is because investment doesn't just cause AD to shift out. Investment also causes the LRAS curve to shift outwards as well. Yeah. As a result, this is what you're going to say. Low savings leads to low investment, low capital accumulation, and thus low economic growth and development. That is wow. Yeah. That is the savings gap. If you get that at a 25 marker or as a 15 marker, that's your chain of reasoning just there. Yeah. You basically explained the Paredomar savings gap. Yeah. Okay. Let's go back and deal with this question as our first analysis then. Well, very clearly, by the way, if I now match the financial sector and its role with the limitations, do you guys agree that obviously one of the roles of the bank is to facilitate savings? That can help to fix the savings gap. So my analysis would be something like this. It would be something along the lines of one way in which the financial sector can help promote economic development is by facilitating savings. One. What I now need to basically do is very briefly explain the problem. Not in crazy detail, though, because the question isn't what are the limitations to growth and development, it's how is the financial sector solving these issues. So you simply go, the Paredomar model explains that savings rate in these economies tends to be low. And part of the reason why is because the banking sector is underdeveloped in these economies, or the financial sector is underdeveloped in these economies, making it very hard for individuals to save. Okay, now we go, if financial institutions, therefore, set up in countries such as Ghana, Ivory Coast, wherever you want to talk about, Rwanda, this makes it easier for individuals to save. As a result, savings rates go up. As a result, firms can now borrow more money from the banks. And as a result, they can invest more. Investment is a component of AD. AD is going to shift out. Investment is also an injection into the circular flow of income. There is therefore going to be a positive multiplier effect. You draw, AD shifts out, economic growth up, and economic development, link it back to HDI because living standards have gone up. If you really want to be safe, you can go, economic growth, government generate more tax, the government can invest it on healthcare. HDI ranking, up. That is your first analysis, and that is amazing. Let's evaluate. There's such a clever eval. You may or may not notice, by the way I just explained the solution to the problem. I ignored something on purpose. The evaluation here is, okay, yes, having banks would really help, but it doesn't fix the underlying issue, which is their GDP per capita is super low. These guys have so little income. If I put a bank in the middle of a slum in India, are they suddenly going to en masse start saving their money? They go, oh yeah, I've got there's a bank. Let me go that. Obviously not. If savings are if incomes are low, then realistically, even if you don't have, even if you have a bank to save in, you don't have the money to save. That is a phenomenal evaluation, by the way. You go, this doesn't fix the underlying issue. Ultimately, they have low levels of savings because of the fact that their incomes are low, not necessarily because the banks are not there. That's the eval. Second analysis. But in order to do that, let's go back to our revision. Number two, is the foreign exchange gap. Again, as another limitation, the foreign exchange gap is, again, the Harrod-Domar model, yeah? The Harrod-Domar model is broken into two parts. Let me just talk about the foreign exchange gap. Now, those of you that have been part of the stream earlier on, if you're not, watch it back later. I spoke to you guys about the importance of foreign reserves. Foreign reserves are simply other currencies in your economy, and they play a vital role. The reason why they play a vital role is because typically the currency of developing economies like Turkey, like Ghana, like, I don't know, whichever country they give you, are usually low or weak, and especially compared to like the dollar and the euro and the pound. And this is why, by the way, think about it. When money, like hot money flows, where are investors more likely to be saving their money? In a developing economy or in a developed economy? Probably in the developed economy, it's safer. So you're more likely to leave your money in Switzerland, more likely to leave it in, I don't know, the UK, the USA, wherever. Hot money, therefore, typically, there's something called capital flight, where money moves out of a developing economy into a developed economy. Cool. This contributes to this problem because it means that they don't really have many foreign reserves. And the issue with not having foreign reserves is this. Imagine my currency goes into free fall. So let's say the lira again. The lira depreciates against the dollar. Do you guys agree that in order for me to import capital machinery, I need to convert more and more of my lira to get $1? Is it easier or harder for me to import things like capital machinery? Well, it's much harder. As a result, is it easier or harder for me to develop sectors like manufacturing? Again, it's harder. That is a problem. So the first problem is that if I don't have enough foreign reserves, if I don't have enough dollars, the second my currency depreciates, it becomes more difficult for me to import because my terms of trade are deteriorating. But the second thing is this, and I gave you guys a clue. It loops back. What did I say was a problem about Turkey? Why did I say it's not a good idea for their currency to depreciate? Most developing economies are indebted in foreign currency, the dollar. If I have a lot of debt and suddenly my currency depreciates, do you guys agree that I need to convert more of my currency to buy $1? As a result, do you guys also agree that causes the real value of my debt to go up? If I don't have foreign reserves and my currency gets weaker, I'm a struggle to basically pay off my debts. That is the second analysis. Third analysis. By the way, that problem could be resolved if you have a strong tourism sector, which also, by the way, is fairly topical because of the fact that they could talk about the tourism sector and then speak about how COVID would have had such a bad impact on the tourism sector. I recommend, I know you guys are running out of time, the exam is in 2 days, but I recommend Old Spec Unit 4, June 2017. There's I think a 15 marker on tourism in Bolivia. Do it later. Anyways, let's go. Number 3 is a massive, massive limitation. It is so big that it could literally be a 25 marker in isolation. Primary product dependency, PPD. Let me explain primary product dependency in as much detail as I can. Right, just before that, let me just quickly see if I got a charger for my phone because the TikTok one is on 24% or so. So I want to die on us. Let's see if we can charge. Right, so we can also take a little breather. You guys can breathe and relax a little bit while I see if I can charge my phone. Right, so 1 second. Okay, it is charger. Hello. Okay. Are we ready? Primary product dependency. Starting point. What is a primary product? A primary product is simply anything that is sourced from the earth, anything that you can grow. Examples. Another name for a primary product, by the way, is a commodity. And commodities can either be soft commodities or hard commodities. Soft commodities are like agricultural products like wheat, barley, cocoa, etc. Hard commodities are like metals, like zinc, copper, gold, aluminium, blah, 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 blah. Now, whatever it is that you're dealing with, but especially agricultural products, you basically would do the following. So you go, okay, if I show you guys, so if you look at my board, so again, if you guys are on TikTok and you've recently joined, highly recommend you guys get onto YouTube because you can see what I'm drawing. If I were to map out the price of a commodity over time, the price of the commodity typically looks like this. It is wildly volatile. It fluctuates like mad. And there's a good reason why. The good reason why is because of the fact that primary products are very vulnerable to external shocks, such as weather. You can't second guess if it's going to be a drought or the best like weather in the world. Therefore, you have violent fluctuations in the price. And this is really problematic. Because if you're a country that is reliant on exporting this good, example, the Ivory Coast, if you guys look at the data response, I believe either 2020 or 2021, paper 2, it shows you that the Ivory Coast, 54% of their exports, if I'm remembering the stat correctly, are cocoa. 54% of the Ivory Coast exports Oh, cocoa. Okay. Let's say the price of cocoa plummets over here, down here. Yeah. What is going to happen to the amount of revenue they generate from their exports? Well, think about it. Cocoa, is it elastic or inelastic? Do you guys agree that the demand for commodities is going to be inelastic? Like if the price goes up, I'm not going to dramatically decrease my demand for like food. If the price go down, again, I'm not going to go wild and start eating everything. So therefore, demand is also not very reactive. Right. So if I said to you the price has plummeted, so here's P, so it's got an arrow down. Demand is going up. Of course it is. Demand must be going up. But if it's inelastic, does that mean that the price, sorry, does that mean demand is increasing dramatically or a little bit? It's increasing just a little bit. So therefore, I'm going to put another arrow next to price. The price is dramatically falling, demand teeny tiny increase. Are they therefore generating more or less revenue? Well, they are generating less revenue. Clear? In that instance, then, are farmers better off or worse off? They're way worse off. And if this employs thousands of people in your economy, they're going unemployed. If this is the main export earnings of your economy, your export earnings are on the floor. If this is the main way the government generates tax revenue, your government are generating next to no tax revenue. If this is the biggest source of growth in your economy, your AD curve is shifting in. You have major negative growth. That is the first scenario. You go, oh my God, that is disaster. Scenario number two, though, is what if the price skyrockets because of an increase in demand? So let's say suddenly there is a lot more demand for cocoa for whatever reason. Yeah. The issue, though, is that cocoa producers, the cocoa farmers, can they significantly increase their output? Well, the answer is no. And the reason is because the PES is inelastic. Think about why. This is, by the way, from the Unit 1 old spec. I can't remember what year it was. I think it was June 2011 or 12. They had a question about cocoa. Now, I would not know this if it wasn't for the data response. And I recommend you guys get real world knowledge from the data response. You guys know how many years on average it takes for cocoa trees to harvest, for them to actually give you a cocoa? The answer, real world knowledge for you, 5 years. It takes on average 5 years for a cocoa. In other words, even when the price of the commodity shoots up, can the producers of cocoa suddenly increase their supply? Well, the answer is a definitive no. As a result, they cannot even benefit that much when the price is really high. Make sense? So you go, look, price really low, disaster. Price really high, not that great. The other issue is this, is because the prices are so volatile, because of the fact that prices are so volatile, is it likely to make it easy for you to invest or not invest? You're going to not invest, right? Because you don't know what's going to happen to the price. Is it going to attract or deter FDI? Well, it's going to deter FDI. Make sense? And that is the first analysis that you could do for primary product dependency. Make sense? So you basically go, oh, primary product dependency, big problem, and this is why it's a problem. Yeah? We'll deal with how we fix it in a moment. Before that, I want to explain to you guys something called the Prebisch-Singer hypothesis as revision. Right. Prebisch-Singer. Let's do it. Right, this is literally like a marathon. I am so unfit. I am dying over here. I don't know about you guys, but said I'll do 3 hours. I'll do 3 hours. We'll do 3 hours. Let's go. So, shall we chat? First things first. Can I just go through the Prebisch-Singer? You guys can watch it back and memorize word for word if you like to later on. It says the following. It says, the Prebisch-Singer hypothesis states that countries that export primary products will be able to import less and less for any given level of exports over time. This is because the YED, so the income elasticity of demand, for manufactured goods is greater than that of primary products, especially food. I'll make sense of this in a second, I promise, yeah? So here, by the way, food will be like cocoa. Given this, when global incomes rise, there is likely to be a bigger increase in the demand for manufactured goods compared to primary products, and thus the relative price of manufactured goods will be higher than that of commodities. Right, I'll explain this in a second. Last sentence, given this, countries who are exporting commodities and importing capital machinery like manufactured goods will experience a deterioration in their terms of trade. Okay. Can I just make sense of this? Again, if you are on TikTok, I highly recommend you get onto YouTube, yeah? This is what it looks like. So I'm going to draw a very basic diagram. I'm going to do 2 side by side. So quantity, price, supply, demand, P1, P1. Okay, let's assume this is the Ivory Coast. So the Ivory Coast are exporting cocoa, yeah? And next to them, I'm going to draw a manufacturing country. So this one, right. D1, right, okay. So let's say, I don't know, let's say this is Germany or China, someone like that. Okay, I have aligned it, by the way, on purpose. Let's say China. Okay, first things first. We assume that global incomes are always rising. There are very few exceptions to that rule. The global financial crisis, even then, the global incomes went up. The 2008 financial crash, they went down, and in the Great Depression in the 1930s, they went down as well. Anyways, other than that, honestly, like incomes are pretty much always going up. Yeah. Now, if incomes are going up, we assume that both the commodity, so this is the primary product, and this is the manufactured good, they are both normal goods in the sense that as income goes up, the demand for them will go up. But we said the demand for primary products like cocoa is inelastic. In other words, when your income goes up, so global incomes are going up, there will be more demand for primary products, but only a tiny increase in demand. It's not going to be a dramatic increase in demand. So we go, okay, let's do something like this. The demand for the Ivory Coast shifts out. Good for them. Actually, sorry, before that. Sorry, my brain is not working. Right, let's go back a second. Just to make this easier for you to understand. Right, in my made up example over here, I purposely made it so the price of the cocoa or the commodity, P1, is the same as the price that China is selling for their manufactured goods, yeah? If that is the case, and I told you, okay, let's say the Ivory Coast export 1 unit. They sell 1 unit to the world. How much can they buy from China? How much can they import? Well, do you guys agree that it's 1 for 1 because the price is the same? Cool? Park that thought in your mind. So in other words, for every 1 unit that the Ivory Coast are currently exporting, they are able to import 1 unit. Okay. Now we said global incomes are going up. So global incomes going up translates into higher demand. But because it's income inelastic, demand only goes up a little bit for the Ivory Coast. So good for them because they're going to sell more and they're going to get a higher price. Okay, that's good. The thing, though, is that we said the demand for manufactured goods is significantly higher than it is compared to primary products. In other words, demand, is it going up a little bit or a lot? Do you guys agree that demand doesn't just go up a little bit, demand dramatically increases, yeah? Hence why you'll see something like this. And now the price for China, it doesn't just go up a little bit, it's going to go up a lot according to this theory. Okay, with that in mind. You know how earlier I said to you guys, when the Ivory Coast sell 1 unit to the world, they were able to buy 1 unit from China. If they now sell 1 unit at P2, can they still buy 1 unit from China? The answer is a definitive no. And if you think about it, that means their terms of trade are deteriorating. Does that make sense? That is the Prebisch-Singer hypothesis explained, and hopefully that makes sense. Yeah? Let's evaluate. So if we now go back to the previous page, if I can find it. Where is it? We had this. Okay. You know how volatility of prices? A very, very good evaluation to the volatility of prices is to utilize something called forward markets. Yeah? Because forward markets is where producers in advance agree to sell their commodity for a fixed price. And they are guaranteed to get this price regardless of what actually happens to the market price. No matter what happens to the market price, they're going to get that price. Cool? That means that it's so much easier for you now to plan ahead with much more conviction because you will agree a fixed price for your cocoa and know you're going to get that price. Investment, therefore, might go up. Does that make sense? By the way, if you want to practice a question on forward markets, June 2019, paper 2, 5 market. Yeah? You normally get forward markets in markets that are very volatile. So the first volatile market obviously is commodities. I just showed you a second ago, but also foreign exchange. Foreign exchange like typically goes like that, like crazy. So if you're a firm, like the one in June 2019 has an extract about a firm, they were exporting and importing a lot. The last thing you want is suddenly for there to be like a significant fall in your exchange rate, because the consequences of that happening is that your currency, now you need to convert more of it to be able to get the same amount for your exports. You're worse off, basically, as we did earlier in the stream. Happy? That is how you answer that question, by the way, in terms of analysis. You basically say, okay, another way in which the financial sector can promote development is through the use of forward markets. Easy peasy, yeah? Right, the evaluation, I'm not gonna lie to you, is not amazing, but you can already tell if a question is very difficult by looking at the mark scheme, because if you see something on the mark scheme that says something along the lines of prioritization of points, normally that means the exam board themselves are like, it's kind of hard. We may not know how to answer this ourselves. We don't know how to like properly develop this. In which case, normally they're a bit more lenient, by the way, in terms of how they're going to mark it. But there is a point on there which I think we can flesh out. Let's deal with it. If I can identify another limitation, in fact, you know what? Let's go through a couple of other limitations of division really quickly. Number 4, one of the problems is corruption. Corruption in these countries tends to be very, very high. That's a problem. Number 5, civil war. If there's a civil war going on, obviously state resources are being diverted towards things like, what's it called? The war, like weaponry, not on education and training. That's a problem. Number 6, bad governance. Basically means that the government in that economy are mismanaging their economic affairs. Big problem. And number 7, last one. I mean, there are others as well, but number 7 is low human capital. Right. In other words, the skills of the workforce are very limited because education rates are very, very low in these economies. Cool. There are others as well. I'm sure you know loads of them. Yeah, but that's just like a pretty decent list there. Okay. I'm going to use one of those to evaluate how forward markets may not be the solution. And it is number 7. Literacy rates in these economies tends to be quite low. Now, if literacy rates are low and education standards are pretty bad, then do you agree that financial literacy will be low as well? There'll be a lot of what's called financial illiteracy. In other words, how many farmers are actually likely to be using forward markets? Would you guys agree, realistically, a lot of them are not realistically going to use it, right? They're going to be like, no, thank you. Yeah. Therefore, it is an imperfect solution because of the fact that they may not have the kind of, and it's a bit rude, but to say like the education level may be high enough to be able to understand how forward markets work, and the uptake may therefore remain low, and this doesn't resolve their problem, doesn't resolve their issue. So that is financial sector combined with economic development. Let's go. Got one more thing that I want to do for economic development, and then we'll move on. Right, let me see my list. Done. Most of it done. Oh my God. Right. Okay. Let's go. Unshare this. Back to the question about India. I don't know if I actually showed you the question about India. June 2015. I think I opened it. Oh yeah, here we are. Hello, India. Right, June 2015 says, 10 marker, examine the case for the Indian government using policies to stimulate domestic manufacturing as a means of promoting economic development. Okay. Can you, based on the question, figure out what topic this is? Impress me. I'll give you guys 30 seconds of me breathing and getting my breath back to work out, based just on that question, what is that topic? By the way, the answer is obviously not economic development. Obviously, it's economic development. Like, there's more to it than that. This is one of the main strategies to economic development that I need you to understand. And it is the Lewis model. Bear in mind, the Lewis model was asked about as a 5 marker in paper 3 of June 2022. Doesn't mean they can't ask it again, nor does it mean that you can't use it. But it can also be disguised like this, where it doesn't explicitly say, hey, this is the Lewis model, guys. But the idea is that developing the manufacturing sector is a strategy to promote development, and it's specifically the Lewis model. Can I walk you through the Lewis model? This is how the Lewis model works. The Lewis model argues that in developing countries, one of the big problems they have is that they are too reliant on primary products, and they need to industrialize, they need to develop the manufacturing sector. What he says is as follows. You guys, look, there is an excess supply of labor in the agricultural sector. Right, can I make kind of sense of what that means? Imagine that we have a farm, and let's say it's a really small room. Yeah, in fact, the room I'm in now is a very small room. Let's assume that on that farm, there were 100 farmers, to the point where like hardly any space is available. They're like crammed together. Yeah. The marginal productivity of labor, right? Let's dissect that word together. Marginal, one more unit. Productivity of labor basically means if I add one more farmer to the farm, how much output does that farmer bring to the farm? Tell me. If I have an already overcrowded farm and I now add another farmer to the farm, how much output does that farmer produce? What's their marginal productivity of labor? Well, according to the theory, it is basically 0 or close to 0. And that is based on a concept that you should know about from theme 3, micro. It is based on the law of diminishing marginal returns. In other words, the farmers now get to a point where they're simply getting in each other's way. There's just too many of them. According to the Lewis model, this is what you should therefore do. The Lewis model says, take the excess labor out of agriculture and into manufacturing. And the reason why is because the opportunity cost of moving excess labor out of agriculture and into manufacturing is what? There's nothing. There is no opportunity cost. It's nothing, right? As a consequence of doing that, you develop your economy in 2 ways. 1, the first way you develop your economy is as follows. You go, you are no longer as primary product dependent. If there's a downturn in the primary product sector, this is not as fatal to your economy as what once was when you were primary product dependent. One. And number two is it is likely to attract foreign direct investment. TNCs like to go where they have a strong manufacturing sector because they can produce their goods, manufacture there, and then sell it to other countries. Cool? Let's deal with this though. If you ever get a question about FDI, think of me in the exam and think of it in the following way. It's the easiest thing that you can churn out like this. FDI, so fast. Let's go. Investment is a component of AD. AD will shift outwards. Investment is also a injection into the circular flow of income. And so there's likely to be a positive multiplier effect. Bonus point, by the way, in developing countries, is the multiplier big or small? It is big because the MPC is high. You can work it out later. Plug it into numbers. MPC being higher, bigger multiplier. Yeah, it rhymes. Anyway, so the MPC is high. You shift out AD. What happens to economic growth? Economic growth goes up. What happens to unemployment? Goes down. Amazing. That is an incredible first. And how easy is that? By the way, as an alternative analysis, if I got this as a 25 marker, Dreamland, or 15 marker, you can also talk about how TNCs would come into your economy and it is in their interest to improve the infrastructure. If let's say it's like a hotel chain goes and sets up in Bolivia or whichever country it's dealing with, yeah? Do you guys agree that if I'm Hilton, I want to ensure that customers can get from the hotel to my hotel, from the airport to my hotel? Do you agree that as a result, I'm going to improve the roads? But when I improve the roads, does it only benefit my firm? No, it's going to benefit other firms. You can now chuck in a micro concept. Don't be scared to bring in micro concept. As long as you're not drawing me like a cost and revenue diagram or drawing me like an externality diagram, you're good. It's completely fine. Yeah. If Hilton develop, or whichever like TNC develop the infrastructure in the economy, on a macro level, LRAS will shift that. Nice, beautiful. On a micro level, you can talk about this being external economies of scale, and that is wow. External economies of scale is where the long run average cost for multiple firms now go down. All of the firms can now benefit from this particular technology or this particular improvement in infrastructure. That's amazing, by the way. Yeah, that could be your second analysis. Anyways, back to our analysis over here. So the question says, examine the case for the Indian government using policies to stimulate domestic manufacturing as a means of promoting economic development. The wording of the question, by the way, is not what policies could they use to improve manufacturing. That's not what it says. It's basically it's like the case in favor of doing it. Why is it good to develop the manufacturing sector? You basically start with the following. Strong manufacturing sector is likely to promote economic development. Lewis model. Explain the Lewis model I just did a few minutes ago. Yeah? Talk about how developing manufacturing helps in two ways. One, it diversifies the economy, so it's no longer as vulnerable to external shocks, to like the primary product sector or whichever sector they specialize in. And then two, FDI. And then you're on Happy Land now. Investment component of AD, bang, 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 bang. There's a great evaluation of this mark scheme. And to be honest with you guys, this is why going through loads of papers is really good. I would not have come up with this evaluation had I not read the mark scheme. Yeah? Mark schemes are amazing ways. I need you guys to understand that if you can give them points that are on the mark scheme, you're much more likely to get credit because the mark schemes repeat. There's a really, really cool thing that you could talk about. Yeah? Which is that TNCs tend to be footloose. Well, I don't know how to do like dramatic music, but if I could play footloose music now. What does that mean though? How's footloose? Footloose means they have absolutely zero loyalty to that country. And the reason that they're typically there is usually because the labor cost is so low. In other words, imagine that they go and set up their manufacturing process in your country, yeah? And then suddenly another country opens up and that country has a manufacturing sector that they've developed. And guess what? Their labor costs are even lower than yours. What is the TNC going to do? The TNC goes, adios, guys, bye-bye. I'm going to go over there instead. Yeah? That is footloose. In other words, it is problematic. The problem is that you basically aren't, it's not a really like kind of reliable source of government tax revenue and income. Also, by the way, they might not even pay tax. They might utilize things like transfer pricing, Starbucks, UK, in 2018, paper 3, read about it, yeah? Talks about how Starbucks pay practically no tax in the UK. These are the kind of things that you could use as evaluations. You could also, by the way, evaluate by saying, well, actually, maybe they have a comparative advantage in another sector. Now, the extract here says they're doing pretty well on services. So you go, look, maybe they should specialize or really focus all of their energy on, on the services sector, because they seem to do pretty well there. Forget manufacturing. Why are they doing that? Go services and basically have that as your evaluation. Clear? That's how you answer it, by the way. And that 10 marker, I only want one evaluation in decent detail. Yeah? So any of those. You could talk about, that it's bad because TNCs could also come in, destroy infant industries in your economy. They might struggle to be able to compete with you, etc., etc., etc. I'm losing my voice, but we're nearly there. Right, let's go. Next question is really, really important. We're going to do it as a 25 marker, but I'm going to show you a data response similar to it so you understand how you can use data if you want to practice it later on. We are going to open the specimen paper. The specimen paper has a question, and I cannot emphasize enough. So as you would have seen from paper one, I think someone commented on my paper one Q&A, oh my God, your predictions were amazing. I didn't predict. I don't predict. I don't believe in predicting. There are hotter topics, yes, but honestly, you should be prepared for every eventuality. In the last live stream, I went through, to be honest, I can't even remember what I went through. I went through things like impacts of higher costs and cost of revenue diagram. That was your 25 marker. I went through contestability. If I didn't, it was one of our YouTube videos literally would have answered that question for you. Yeah. Etc. Again, I'm not saying this to be like, oh, I predicted it. No, it's not about predicting it. But if you basically are in a position where you know everything, it doesn't matter what they throw at you, just bat it away like easy peasy. Let's go. Yeah. This, though, is what I refer to as a hot topic. I thought it would come up last year. It hasn't. It makes it a bit hotter that it might come up this year. I think the extracts in relation to the Eurozone are outdated, are kind of overdue. And the reason why I'd argue that they are topical is for two reasons. One, Croatia joined the Eurozone 2 years ago. So they will have data on Croatia. That could be the stem for the 25 marker, or it could be an extract and you can get a 15 marker. But at the same time, number two is that Eurozone countries have experienced so many issues. Their debts are so high. Some of them have brought their debts down. Some of their debts have gone up. So you can get a question similar to what we did earlier on in the stream. If you were coming in late, watch it back on YouTube later, yeah? So I feel like it's fairly topical. Not to say in any way that I know, I promise I don't know. And at the same time, like it might not be that, it might come up in paper 3, it might not come up at all. Who knows? This is the question I want us to look at. Right, annoyingly, the specimen paper, they don't have one page which has all the questions there, which is very annoying. So we're gonna have to work our way to the 15 marker. Here it is. And the 15 marker is this. Discuss the likely costs and benefits of monetary union to the 5 members of the EAC. In the same way, the question could be asked, evaluate or discuss the benefits and costs to Eurozone countries, sorry, not Eurozone, to Croatia of joining the Eurozone. Are you guys ready? Let's deal with it. I'm going to share my screen and we're going to write the best essay that's ever been written in the history of man. Right, let's deal with it. By the way, this question, old spec, was asked, I can't remember what year, I think it was June 2010 or 11. In their big question, they basically said that the UK is part of the EU, but doesn't currently have the euro. What is the benefit of joining the Eurozone? And obviously that ship has sailed. We've left the EU, let alone like joining the Eurozone. That's not going to be asked in that way, but the points are still the same. The points are literally exactly the same thing. And if you get any question on any trading block, starting point number 1 is I want you to talk about trade creation. Trade creation is literally what the name explains. Trade creation is where the volume of trade is going up because of the fact that there are easier trading conditions. And there are 2 things that you're going to talk about here. Number one is the fact that they are better placed to tap into their economies of scale. Sorry, no, I'm so tired that I'm wrong. They are better placed to tap into their comparative advantage, which is where they have a lower opportunity cost in the production of a particular good or service. And that enables them to specialize and then trade. If I have time, I'll show you guys the mathsy question for comparative advantage to wrap up this session, maybe. Let me remember, I'll put it over here. Yeah? Okay, the other thing that you could talk about here, by the way, is that do you agree that because of trade creation is also beneficial in terms of the firm because the firm now never ever need to worry about unfavorable exchange rate movements. This is specifically for a monetary union. Because imagine the following, yeah? So imagine I know the UK is obviously not even part of the EU, but let's just use the UK to get our head around it. If £1 equals €1, let's just say that was the case, yeah? And I'm a big exporter and importer. I trade a lot with the EU because they're my neighbors. Geographically, they're close. I do loads of trade with them. Okay. Suddenly, the pound goes into free fall. £1 is now worth half the amount of euros. Okay. Do you guys agree that my profit margins are being squeezed? Because if I'm in a contract, my exports, the quantity is staying the same, but the amount I'm getting per unit is way lower. And everything I'm buying is now more expensive because I'm going to have to convert more pounds to buy euros. Cool? This is a problem. But the thing is if I look at countries like Croatia now, who are their main trading partners? Well, I'll tell you who their main trading partners are. Germany and Italy are their main trading partners. What currency does Croatia now use? They use the euro. What currency does Germany use? They use the euro. What currency does Italy use? They use the euro. Can one euro ever be stronger or weaker than another euro? The answer is no. Therefore, you now can plan ahead with so much more confidence. Yeah. By the way, this is actually why you might have a fixed exchange rate. So countries might peg their currency against another currency so that trade, if they do a lot of trade with that country, firms can also kind of just go in advance. I know no matter what happens, my central bank are going to manipulate the exchange rate to move in tandem with my main trading partner. I never need to worry about the exchange rate moving and affecting me negatively. That's our first analysis. Easier trading conditions, higher revenue for the firms. You can also talk about how they can tap into greater economies of scale, like managerial. There's free movement of labor. They can attract the very best workers from across the block. That is our analysis. That's an amazing analysis, yeah? I will deal with the evaluations in a moment. Let's do the second analysis in terms of a plan. Again, easy. Number 2, do you guys agree that being part of a trading bloc, especially a monetary union, but any trading bloc, results in foreign direct investment, FDI? Why? Imagine I'm Coca-Cola. If I'm Coca-Cola, why does it make sense for me to set up a base in the Eurozone rather than sending my products from America into the Eurozone? The reason why is because if I sent my products from America into the Eurozone, I would have to pay the common external tariff. I have to pay a tax. I don't want to pay a tax. So what am I going to do instead? I'm going to instead set up a base in the Eurozone. And then when I export to neighboring countries in the Eurozone, I don't pay the tariff because I'm exporting from within the bloc. Make sense? One of the biggest beneficiaries of the Eurozone are Ireland. If you look at the data for Ireland, their economy has thrived because of the Eurozone. I don't know if you guys know they have the Euro. And the reason why, by the way, partly is because their corporation tax is low. So the following companies have all set up their headquarters in Ireland, as far as I remember. So Microsoft, Google, Pfizer, Johnson and Johnson. Anyways, all of these guys. Yeah, like loads of them. If you look, by the way, at their GDP per capita, it is one of the highest in the world because everything being generated there by all these tech giants counts as GDP for Ireland. A bit deceptive because it's not Irish, but whatever. Anyway, the point is that it might attract huge levels of FDI because the TNC not only wants to take advantage of the easier trading conditions, they also want to avoid paying the common external tariff. True? Your point then is simply this. It's going to attract FDI. You can reference Ireland as your example. And once you basically talk about their the TNC is coming in, you're in happy land. Why? Because FDI, investment's a component of AD. AD is going to shift outwards. It is also an injection into the circular flow of income, positive multiplier effect. Bang, bang, bang. Draw it, summarize it, high five the invigilator if you want. Happy days for you. That is our analysis, and those are great points, yeah? Let's evaluate. Because the evaluation for this essay is absolutely monstrous. And this evaluation, number 1, is the one you have to do. It is the one I always want you to do. Yeah? And it goes like this. How many central banks are there in the Eurozone? There are 20 countries in the Eurozone, but there is one central bank. That one central bank is called the European Central Bank. And they have to set an interest rate that works for all of the countries. When they set up the Eurozone, they kept talking about it as, one size will fit all. One size will fit all. One size 100% has not fit all, and we're going to use 2 extreme examples to illustrate this with. Germany, Greece. Because whilst the German economy a couple of years ago was booming, it was doing so well, the Greek economy was in a deep, deep recession. You are now the central bank in the Eurozone. You're the European Central Bank. You're Mario Draghi at the time, yeah? Okay. Let's do some revision of monetary policy. And I tell you now that the German economy is booming. Now, when the German economy is booming, typically growth is very inflationary because you're probably operating near to like full capacity. So let's say we're over here somewhere. So imagine this is Germany. They have high inflation, yeah? What kind of interest rate would Germany need in order to remove the inflation or reduce inflation? Well, I want to shift AD inwards, right? How do I do that? I raise the interest rate. So Germany want a high interest rate. But the thing is Greece are all the way over here. Greece are like dying over here. Their economic growth is so low. What do you therefore need to do to their interest rate? Well, you need a low interest rate for Greece. Can I achieve both? Can I give a high interest rate to Germany and a low interest rate to Greece? Impossible. It's not possible. They have the same currency. There's one central bank. This is a massive problem then. The problem is that you cannot cater to all individual countries' needs And therefore, those countries have lost one half of their demand side policy. Demand side policy is a monetary and fiscal, right? Your monetary policy is gone. It's out the window. It's not up to you now. The only thing you have control of now is fiscal policy. This is a massive, massive problem. Like massive, yeah? To add to that, by the way, again, I've amended the stat and it may be outdated. Look, they technically shouldn't really be telling the guys this, but like within reason, you could probably make up some stats. Example, in the exam report for the question in June 2022 about protectionism, kid who got a really high mark talked about how Algeria have placed a quota on cars of 90,000. Googled it, 50,000. They didn't go, oh, you liar, oh my God, you liar, or on DocuMarks, yeah? Same as like the June 2019 paper has an extract, or the 25 marker was about wage differentials in paper one. The whole of that extract, or that's the answer in the exam report was about football clubs. And they talked about how like the average salary of a Burnley football player was like, I think £20,000 per month. I Googled it, nonsense, not true. Again, they didn't write, oh, this guy's a liar, they're a liar. Dock the marks, yeah? Within reason, you can just make up stat. Don't do stupid stuff though. Like you should know what the inflation rate is in the UK. You're going to get it all on our Instagram tomorrow. You should roughly know what the debt as a percentage of GDP is, etc. Anyways, point is this: you go, okay, my added bonus stat. This is just as an additional thing. I didn't need to do this. And if this doesn't make sense to you, don't worry about it. As long as you understand they've lost monetary independence, and that's a big problem. Our stat is this: home ownership in Greece is approximately 75%. By the way, I can't take credit for this, just to clarify. In the exam report about the answer, where it was about whether the UK should adopt the euro, this kid wrote this. Honestly, that was the best answer I've ever read in my life. It was wow. Anyways, we'll deal with it in a sec. So Greece, 75%. Germany, home ownership is roughly about 45%. Last time I checked, it may be about 50%. Who knows, yeah? There's a culture of renting in Germany. Why am I telling you that stat? There's a reason why I'm telling you that stat. The reason that stat is relevant is because of the fact that when the central bank adjusts their base rate, the central bank interest rate, do you agree it will impact the Greek economy more than the German economy? Because a lot of these homeowners will have mortgages and tracker mortgages specifically. If you don't know what a tracker mortgage is, watch later on my video on monetary policy. There's like an 18-minute video where I take you through how to answer that. The point then is this: you go, listen, if you are on a tracker mortgage, you literally can have like it has a much more profound impact on you when the Bank of England, the European Central Bank, reduce or raise their interest rate compared to a country that doesn't have many homeowners. Is that super duper clear? Yeah, that is phenomenal analysis. Evaluation. It is so good. The problem with Croatia now joining is they cannot set an interest rate that is tailored towards their economy. Okay, let's do one last eval. One last eval is to talk about how, by the way, this topic, if you think about it, trading blocks comes under the remit of what? It is within globalization, if you think about it. Like globalization is closer integration of countries. They basically form like trading blocks, blah, 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 right? And you can now tell me a bad thing about globalization. And one of the bad things about globalization, as evidenced by COVID to an extent, but there's even better data here, countries become too interdependent upon one another. They start to rely too much upon one another to the point where if one country mismanages its economic affairs, it is likely to spill over to all the other countries as well. Example, I know we like picking on them a little bit, Greece. Yeah? The example is Greece. Greece mismanaged their economy to the point where they have a significant debt crisis. Their debts go up so much that they eventually have to get bailouts from the IMF and the European Union. And the amount that each Eurozone country pays, by the way, depends on the amount of their GDP, how strong economically they are. The highest, obviously, then is Germany. You know what the estimate is in terms of how much Germany has paid towards Greek bailouts? The estimate is a whopping 56 billion euros is how much Germany have contributed to the Greek bailouts. That is huge. France, by the way, 42 billion. This is massive numbers. We're not talking like small numbers here. In other words, if your main trading partners go through an economic downturn, now that doesn't have to be a debt crisis. It should be like if Italy and Germany mismanage their economy and get negative growth, you guys agree that realistically they can't afford to buy as many Croatian goods. Their exports therefore dry up, their AD curve shifts in, economic growth contracts. Bad. That is our evaluation. Yeah? Can I give you guys the judgment for this question? And the only reason I'm telling you this judgment, and again, I take no credit for this. This was this kid, honestly, whoever, if this kid is watching this, I don't know who they are. If their answer is in the examiner report, the year where they asked whether the UK should adopt the euro, I mean, I'm going to get loads of random emails of people pretending to be that person. You are such a legend. You are such a legend because I would have never thought of this. This is so clever. This is what they wrote in the judgment. They wrote that on the balance of evidence. So by the way, the judgment, I want to try and do three things. I want to basically go, one, pick a side. Don't sit on the fence. Two, justify why. And three, offer policy advice. Right, let's start with number one. On the balance of evidence, the costs of joining a monetary union outweigh the benefits. I'm going to go, bad idea to join the Eurozone. I mean, it's a bit late for Croatia now, but like, you go, no, don't do it. Yeah? And this is where the kid comes into his own. This kid, I'm assuming it's the boy based on handwriting. It could be a girl. They wrote the following. They said, the benefits of monetary union are predominantly microeconomic. Think about it. Firms benefit, they can tap into economies of scale. Firms can benefit by basically selling more in the market, etc. Yeah. Whereas the costs are predominantly macroeconomic. Yeah. That, by the way, my mind was blown. I read that. I was like, oh my God, that is crazy. Yeah. And then you add and you go, you can make this bit up. You can just say, at a time of economic uncertainty following the COVID crisis, the Ukraine war, whatever, for no reason whatsoever, we're going to go, macro is more important than micro. Macro is more important than micro. Like you need to basically get growth and blah, blah, whatever, right? That. And in particular, your like reason for them being like, wary of monetary union is to say the contrasting fortunes of Greece and Germany clearly illustrates that one size does not fit all and that losing monetary independence is far too heavy a price to pay for monetary union membership. And you now have smashed it to pieces. That is a wow answer. Yeah. And hopefully that gives you like a really good understanding of a monetary union. I said, I'll do 3 hours. Right. Can I just do one more thing? I honestly don't think I have a voice left. My brain isn't even working. The Red Bull finished about an hour ago. I am so tired. And some of you may already know, around a 6-hour course in person on exam practice earlier today. So I literally came from the course and did this. I'm shattered. Can I just do one last question with you guys? And then you can all go to sleep and we can have hopefully good dreams. Right. Let's deal with it. Comparative advantage. I need you guys to understand how comparative advantage works. I need you guys to understand how to calculate comparative advantage. We'll do a past paper question or a question together in a moment. In order to understand comparative advantage, though, I want to take you through not a theme 4 question. I want to take you through a theme 1 question. In the June 2013 paper, in fact, you know what? I'll show you. In the June 2013 paper, question number 1, kids opened their paper that year and were like, what is this? And I'm going to use their question to show you comparative advantage. And obviously, theme 1, they weren't asking about comparative advantage, but not far away from it. It was about two people. One was called Bob, one was called Wendy. This is question number 1. Are we ready? Hello, Bob and Wendy. Oh, hello, Bob and Wendy. I'm not interested in anything underneath it, yeah? We're just looking at this. It says, this is basically the PPF for 2 individuals. One is called Bob. This is based on Bob the Builder and Wendy, who apparently is his girlfriend, right? Anyways, Bob and Wendy. Hi, Bob and Wendy. Remember, by the way, that PPFs can be straight lines. They don't necessarily need to be curved, yeah? And now what I want us to work out is I want us to work out opportunity cost. Because absolute advantage simply is where a country can produce more of a good or service than another country. Or in this case, who can produce more of a good? Well, clearly, Bob has an absolute advantage in the production of bedrooms because he can make more bedrooms than Wendy. And Wendy has an absolute advantage in the production of bathrooms, yeah? But what if I wanted to calculate the opportunity cost of producing a bedroom? Quick revision from theme 1. First things first. If I want to calculate the opportunity cost of anything, you guys need to understand that your answer must be expressed in terms of the other good. In other words, if I want to calculate the opportunity cost of making a bedroom, I have to express it in terms of bathroom, my answer. Vice versa, by the way. If I'm trying to calculate the opportunity cost of making a bathroom, I have to express my answer in terms of bedrooms. Let's do it. I'm going to replicate this exact thing on my board so that we can do the maths together. So we had the following. Right. Bed, bath. And we had 2, 4, and this was Bob. And then 4, 2, and this is Wendy. Okay. Pick any player. It doesn't matter. Yeah. Whatever you want. Do you want to do Bob or do you want to do Wendy? Whoever you want. Let's start with Bob. Yeah. So we're going to work out the opportunity cost for Bob. And now the thing that I want to work out the opportunity cost of, or calculate who has a comparative advantage in that thing, I need you to make sure that you leave it on the left-hand side of your equation. So here we're going to work out who has a comparative advantage in making beds. So I'm going to put bedrooms over here, the bed, bath over here. And then let's work through this together. Question number one. If Bob does nothing but bedrooms, how many bedrooms could Bob make? Well, do you guys agree that Bob would make 4 bedrooms? And if he's producing 4 bedrooms, that means he's not making any bathrooms. How many bathrooms would he have sacrificed? Well, do you guys agree that he's given up 2 bathrooms? So I put 2 over here. Cool. I now want to express opportunity cost in terms of 1 unit. I want to go for every 1 bedroom. How many bathrooms does Bob give up? Well, I make this number 1. Right, how did I do that? How did I make the number 4 become the number 1? Well, I divided it obviously by 4. I need to do the same thing to the other side. 2 divided by 4, very basic maths, 0.5. That's Bob. Let's do Wendy. And we have, again, bed, bath. If Wendy does nothing but bedrooms, how many bedrooms can Wendy make? Well, do you guys agree that she can make 2 bedrooms? How many bathrooms can she, or does she sacrifice then? Well, she gives up 4 bathrooms. Therefore, for Wendy, for every 1 bedroom she makes, what does she give up? She gives up 2 bathrooms. I divide both sides by 2 this time. Clear? If I therefore look at the concept of comparative advantage is simply the idea that whoever has a lower opportunity cost in the production of a good or service ought to specialize in that good. Okay. Clearly, Bob has an opportunity cost that is lower than Wendy's when it comes to bedrooms. He has, therefore, a comparative advantage. But can I show you guys why that's a very powerful theory? The reason why that's a powerful theory is because, yeah, obviously, it makes sense that Bob would specialize in bedrooms and Wendy would specialize in bathrooms. Yeah, duh. But now let's look at what happens if they trade. If we assume the monetary value of bedrooms and bathrooms are equal to one another, okay, what is the logical trade that Bob and Wendy should do? So let's say I'm Bob, you guys are Wendy. I make 4 bedrooms. You make 4 bathrooms. It doesn't make sense for me to hold on to 4 bedrooms. It doesn't make sense for you to hold on to 4 bathrooms. The logical trade, my voice is going, the logical trade is that I give you 2 bedrooms and you give me 2 bathrooms. But look at what that output level is. If I look at my diagram, do you guys agree that 2, 2, somewhere over here? So if I go from that point there, across, that's 2, and up there, 2, 2, that X. Well, my X is over on my diagram. Yeah? Do you know something about that point? Do you guys notice that that point is outside of both Bob and Wendy's PPF? It was an outcome that they were incapable of achieving by themselves, and this is why comparative advantage is so powerful. It is so powerful because of the fact that it will enable countries to operate beyond their PPF, and thus living standards become higher due to trade. That is comparative advantage. The only thing I highly recommend that you guys do, I was going to do it with you, but honestly, I feel like I'm actually going to faint on the live stream and you guys will have to call the ambulance or something, is in the specimen paper. Your teachers probably love this question. In the specimen paper, so you can find it on our website under paper 2. Yeah, specimen paper. It has this beautiful question here. The question is this. It shows 2 countries, Zambia and Colombia. Now, the first part, honestly, part A, you really should find that very straightforward, yeah? And then you basically do part B, which is this. Using appropriate calculations, explain which country has a comparative advantage in the production of emeralds. If you lay out your working out in the following way, like I did, you will get that right. Compare it to the mark scheme, and you'll smash it. Guys, I said I would do 3 hours. I'm like 10 minutes shy, 12 minutes shy of 3 hours, but honestly, I think I'm dying right now. So good luck for Monday. I hope this was helpful. Hopefully you guys feel a lot better about paper 2 than before this stream. I will do a stream for paper 3. It will be announced in due course. There is obviously a half term, so it'll be a bit easier to hopefully prepare you guys a good time. Just a quick thing in terms of what I need you guys to do. Number 1 is please make sure that you're very wary of timing. We have timings on our TikTok page, on Instagram. Follow it to the letter. Do not go a minute above the timing. Number 2 is please attempt every single question. Even the questions that you don't feel so confident, please make sure that you are answering them to the best of your ability. Yeah, they don't know that you don't know. Answer it, give it a go, just do your best. Yeah. And even if you felt that paper 1 was a catastrophe, I have done this long enough. I know some of you probably have only just found out about me in the last year or so. I've done this for 17 years. Yeah. And in 17 years of teaching this, I have seen multiple students when I get their scripts back who have done terribly in paper 1 and then smashed the life out of paper 2 and 3 and got an A star. Whatever you think you got in paper 1, if you smashed it, great, keep smashing it. If you flopped it, it's fine. It's not over. It's only 35% for those of you that at Edexcel of your grade. Go and smack paper 2. Go and obliterate it, yeah? I know you will. Good luck, yeah? See you guys very, very soon, hopefully.